Hi guys, I hope you're all doing very well. Just making sure that chat's working. Okay guys, really appreciate your time. There's a lot of stuff that I want to go over, and then there's going to be plenty of time for Q&A. I'm going to do more frequent Q&As, or not Q&As, but live streams. The quarterly reports that we do with eToro, they're kind of short. There's only 40 minutes. There's only a certain amount of data that I can show and then leave enough time for Q&A. So hopefully these live streams will be a little bit better and we can do them more frequently. Hi, Raz. Hi, Tahoe says. Hope you guys are doing very well. Okay, before we get into it, I just want to talk about one thing first and foremost. This comment here came on underneath my comment. I deleted my YouTube channel. And so let's just read the comment for a second and then I'll answer it. I want to take 5 minutes to answer this and then we'll move on from there and we'll get straight into the data and we'll settle any sort of issues that people might have. Okay, so can you address on your live stream why you have removed your other YouTube channel and taken down all your prior videos? I can't help but feel after rewatching a few of your last videos just how off the mark you have been recently regarding the general markets and your sentiment towards some of your larger positions. Okay, fair criticism. First of all, why did I delete the YouTube channel? I did delete it. And the reason why I deleted it, I think it's a good idea to explain why I actually started on YouTube. Hey, Tom, hope you're doing well. The reason why I started on YouTube was simple. We were in a draconian lockdown in Spain and I was on the brink of literal depression. Way too much time on my hand, no exercise, needed to do something. In the past, I'd actually done some YouTube videos on different channels and I've got one there, which we'll talk about in a moment. So I decided to do YouTube videos. Obviously, I prepared to be successful, but I wasn't expecting to be successful. 46,000 people is a lot of people. And when I started on YouTube, there was a couple of core principles that I wanted to get across, and that was diversification is not for idiots. I think you should be diversified. I think valuations actually matter, and I think you need to know what you own. They were the three things that I thought was very important for people to really understand. Now, on the way up, as markets are doing well in 2020 and 2021, everyone's high as a kite. Everyone's very excited about markets. And you don't really know the devastation or decisions that people are making with regards to risk management. And it's only in 2021 where I realized the total destruction of actually posting content the way that I did on YouTube. I'm posting about analysis of companies that I actually own. And the beautiful thing about eToro is I can't hide from that. My stats are available here publicly and it's audited third party. So I'm in a situation where, there's nothing I can hide from. But one skill that I've developed over the last 13 years is risk management. And some of the companies, some of my top positions are way off the mark for sure. That doesn't necessarily mean, well, I'll ask you guys whether it's right or whether it's wrong. What I wanted to point out here is from a macro perspective, which we'll go over right now, the consumer and the economic data, we're not in a recession, right? So from an economic perspective, we're not in a recession. Real GDP growth is trending at about 3% for the entire year. So we're not in a recession. There is real growth above inflation. And so the question is, why did markets sell off? And that's what creates an awful lot of narratives. It's, in my view, it's really got to do with interest rates rising or the expectation for interest rates rising, valuations coming down. We're going to talk about all this today. There's a lot to talk about. But the fact of the matter is the equity price went down while the fundamentals remain reasonably resilient. Back in 2017, this is a video I posted. I bought uranium miners. Mainly it was Cameco, and I bought some solar companies. I bought First Solar and I bought SunPower back in 2016, 2017. And this is a video I done back in April of 2017. And it was just sort of like a guest type of appearance. I done a couple of videos on this guy's channel. And it was really about everything you know about uranium today. It's been known for years. 6 years ago, I came up with that thesis. That thesis has been there forever. But for the first 4 years, if I look at Cameco, I didn't make any money in this, right? So if I look at Cameco, from here to here, I'm down. After 4 years, am I right or am I wrong because the market's down? Well, I'm wrong because I'm not making any money, but the fundamentals didn't change. They actually improved. So I bought more when I could. And ultimately today, if I look back on where the price is today versus what I paid for it, on average, it's compounded at 25% year in, year out for 6 years. Now, I sold out of SunPower and First Solar at a loss, both of those. And so the question is, how long is long enough to say something's right or whether it's wrong? And so time frame matters, valuation matters. And of course, would I like to go back and do things different this year? Absolutely. Mistakes were made for sure. But one thing I realized being on YouTube is the rise of Wall Street bets, all of this gambling sort of mentality, it's not healthy. People are losing a ton of money. They're losing a lot of money. And I certainly did not want to be a part of that whatsoever. So that's essentially why I took a step back, why I deleted my channel, because speaking about specific companies, I can change my mind on a dime, and I did. I sold out of Zillow. I was dead wrong on Zillow. The fundamentals changed to a point where I didn't think I could make money in the next 5 years, and therefore I found another opportunity that I could. I can change my mind. But people are putting like 50%, 70% of their portfolio into one company without understanding it, and that's the biggest challenge. I knew what was going on with Cameco. I knew what was going on in the uranium space, and I could sit through 4 years in a diversified portfolio. Was it easy? No, not at all. It was really difficult, really, really, really difficult. But that's essentially why I decided to close out of my uranium positions. As well as that, I'll point out, the community was a lot smaller back then. It was very different. I met a lot of people that were very, the people in that I met from that small channel, it was all fundamentals driven. People wanted to invest. They cared about time horizons, building wealth, and that type of stuff. And since 2020, it was just a rise of gambling. It was a disgusting sort of mentality that people had. And it became really toxic in 2021 when people started to lose a ton of money because no risk management, very concentrated leveraged bets, literally getting wiped out. Now, the reason why I deleted the channel is not to get away from my results. My results are public. I'm down on the year pretty heavily. Now, I did get hit 2% from when I added funds. I'm down about 24, 25% on the year. Not a good year at all. Can't get away from that. But the content I don't think was very helpful, and that's why I got rid of it. I felt like it was time to get rid of it. And actually, I would like to build a better community, but it's not about growing really fast. Let me show you one thing, actually. One gentleman that I did meet from that video, who we invested in uranium together, was from Chicago. And he sent me a gift, actually, and this is really cool. This here is from the first nuclear reaction underneath the Chicago Stadium. I'm not sure, but that's a piece of history for nuclear power from like 80 years ago. And this little small community anyway, we built a pretty good sort of relationship. We sat tight. It was very supportive. It was fundamentals driven. Everyone was excited to be involved in markets. It's not what you have right now, and that's why I got away from it. So I took a break from YouTube, waiting for it to die down. I might go back at some point in the future, but for right now, I just need to cool off. So that's essentially it. I can't really hide from my results when it's right here. So it's got nothing to do with sort of trying to hide from my results. I mean, it's right here. Am I proud of this year? No, not really. Do I think I'll pick myself back up? Sure. So it is what it is. Anyway, guys, let's get straight into today's update. There's a lot to talk about. I just want to start off here. This is what we went over on the conference call. And I just want to give you guys a brief recap of sort of how I see what's going on, because I think it's really important for you guys to believe in this bigger picture macro sort of outcome in order to have conviction in the long term. Right now, I know there's going to be a lot of questions about overstock. We'll talk about that. I think overstock's probably going to be like Cameco. Nothing for maybe years. I don't know. But then all of a sudden, it's going to reprice very quickly as the fundamentals are fairly reflected. And then in a very short period of time, you get paid for that risk. But we'll talk about that a little bit later. This is really important. Everybody that I'm hearing on the bearish side are essentially talking about 1980s inflation. And back in 1980s, you had high inflation, but you had interest rates rise as well. So as inflation went up, interest rates rise. How are they able to do that? Look here in the top right-hand corner. You got the federal debt as a percentage of GDP. It was down around 30%, 40%, very low debt to GDP. What does that mean? Your tax revenue relative to debt was very high. It was about 41%. So you had an awful lot of income to service that debt. And so when interest rates increased, it wasn't really systemic. 1940s inflation was very different. In 1940s, interest rates, now back in the 1940s, we didn't have the Fed funds rate, but we did have T-bills, we did have 10-year treasury, we did have long duration treasuries as well. So we can still understand how bonds essentially performed back then. You don't need the Fed funds rate. But as you can see here, the 10-year bond yield was flat at around 3%, despite inflation getting as high as 20% in 1947. And the question is why? Well, debt to GDP was over 120%, and similar to where we are today, servicing that debt was very difficult. It was also a wartime economy, very similar today. The reaction to COVID was a wartime economy, plus we're on the fringes of possibly a World War III if we're not already in it. So as of right now, you see massive deficits and you see debt that's really burdening. So the issue is not the consumer. I think a lot of people look back to 2008. It's what's known as recency bias or anchoring in behavioral finance. And it's looking at the most recent crisis and assuming that it's the same thing today. 2008 must be the consumer. Last time we had 8-9% inflation back in the 1980s, must be the 1980s. It's not necessarily a fair reflection. Now, if you have a look at what happened in the 1940s, keep those interest rates low, the Federal Reserve bought them. This was the Fed's balance sheet. In 1942, they started to buy treasuries. This in yellow is held by the Federal Reserve. These are treasuries. And on the bottom here, it's the amount of bonds, so notes, certificates, and bills, short duration bonds that the Federal Reserve bought. This is what's known as curve control. And that's what I think the ultimate outcome is here, where interest rates are flat. As of right now, the market believes that the Federal Reserve can tame inflation, but that's changing. You can see that that's changing by checking out this here. The curve is peaking interest rates at 3.87% in March, and then from there we start declining. So as of right now, that's starting to change. And I think you have low interest rates, higher inflation. The reason why that's important, and we'll have a look at this in just a moment, the reason why that's important is because inflation, let's say it averages at 6%. Where's inflation coming from? Not necessarily crude oil that's falling, not necessarily gasoline that's falling or food that's falling. It's structural. It's actually coming from wages. The labor market is what's driving inflation, and that's structural. And as of right now, at 6.7% wage growth, it's a little bit it's a little bit steep, as well as that you have inflation, or you have shelter, rents and stuff like that. So inflation is going to be a little bit more elevated. So you have 6% inflation. That's the cost of your living increasing every year by 6%. If you hold cash, we have curve control, you're getting nothing, meaning your cash is going to depreciate by 6% every year. If you hold bonds that are fixed close to 3, maybe 4%, you still make a real loss of 2 to 3%. It's a little bit better than cash, but it's not really that great. Equities at 18.8 times price to earnings ratio, which is where it was when I done this. It's much lower now, but you lose about 0.5% buying the index. Not great, but better than cash and better than bonds. And if you dig a little bit deeper, you can actually get much better value. The main takeaway that I'm trying to mention is 1940s is more realistic than 1980s because of the debt levels. The Federal Reserve are likely to do curve control like what you're seeing in Japan. You're likely going to see higher inflation, lower interest rates. The best place to put your money is equities. That's my view. It's not really a view of, hey, the world is amazing, let's go out and buy stocks. It's, hey, if I put my money in the bank, I'm going to lose purchasing power every single year. I want to put it into a company that has pricing power over me, the consumer, and they can keep increasing their prices, increasing their margins, and increasing their profits. And over a long period of time, I'll be able to generate strong returns from that. That's essentially the bigger picture view. I want to be in equities. I don't want to hold cash. I don't want to hold bonds. And any excess cash I have, I want to put it into equities, reasonably priced equities, which we'll go over in a moment. So why is this really systemic? And why are we seeing sort of areas slow down a little bit? Government spending as a percentage of GDP is 35%. 35% of GDP. GDP is 24.8 trillion, and 8.6 trillion is what the government spent last year. That's deficits and tax receipts. So 35% of the economy is spending from the US government. As you can see here, what we're seeing is what's known as fiscal drag. Interest rates push higher. They don't have as much cash in order to spend because they have to pay more on interest. What happens? They spend less. There's a bit of a slowdown. It's called fiscal drag. Companies that are very sensitive to US government, I'd be careful of right now, but that should resolve itself at some point in the future. So if we have a look at, there's another chart here that I want to share. If we have a look at, which chart is it? This one here. So tax receipts are 2.8 trillion trailing 12 months. You need to see real growth in order for that to stay. If people stop spending, government are going to generate less tax. So you need the economy not to be in a recession. Otherwise, that goes down. Let's just assume it stays flat. Public debt's 30.4 trillion, at 3% interest, almost 1 trillion of that. By the way, we're above 3% on the 2-year, we're at about 3.5% as of right now. But that's about $1 trillion. It's about 40% of your entire tax receipts going to interest payments. That's the problem today. That's the issue. It's not the consumer. It's the US government not having enough cash. It's a sovereign debt issue. But there's a solution, like what we've seen back in the 1940s. And I see an awful lot of people make a mistake. One of my favorite investors of all time is Stanley Druckenmiller. I agree with him most of the time. Sometimes I don't. And certainly when he came out and said that the Fed funds rate has always eclipsed inflation in order to bring inflation down, he's referencing the 1980s. That's a mistake. Fed funds rate didn't exist back in the 1940s, but we had T-bills, 1 to 3 year bonds, and they were flat. They were actually fixed at 0.375%, close to zero. So it's known as curve control, and it's happening in Japan at the moment. So we have a solution. We have a sort of model to go off, and it's the 1940s. And that's ultimately what I think we're going to follow. Now, this is important. Let's have a look at the two inflationary periods. So you had 1980s high inflation where it got up to 15%, and then 1940s where it got up to 20%. Let's pop down here. This is the S&P 500. So 1940s when inflation started to increase, what happened? From 40 to 41, the market dropped 32%. But if you bought it in 1940, you sat through a 32% decline. But at the end, in 1952, where inflation died down, you made 130%, including the dividend. That's a compound growth rate of about 9%. You protect your capital. So during the 1940s, equities were a pretty good bet. And that's buying the index. You can buy specific areas that should do a little bit better if you're a little bit smarter, if not owning the indexes very well. In the 1980s, it was very different. You had a pretty strong dividend, but the equity value went sideways. Again, certain companies outperformed, certain companies underperformed, but broadly speaking, the index went sideways during that period. Why? Well, interest rates screamed higher, so the discount rate came lower. But more importantly, in the 1980s, the government had the breathing space to actually sustain higher interest rates. And that's ultimately why, there was no curve control, because debt to GDP was 30 to 40% during that period. So that's the bigger macro picture. And so my view would be, I always believe that we should be preparing for retirement, right? So a couple of decades into the future, you can keep saving, put the money in the bank if you wish. You can put it into safer, near cash, short duration bonds, get a coupon a little bit better than cash. You can hold equities, you can do whatever you want with it. But generating a return over 10, 20, 30 years, even just a couple of percent, compounds into a big snowball. My view is that if you're preparing for the long term, over the next 10, 12 years, holding cash is likely not a good idea. During the 1940s, if you held cash, you lost 70% of your money to purchasing power. If you held equities, you had a real return. So my view is that as we prepare for retirement or whatever your goal is, equities is going to be the cleanest dirty shirt, not because everything's amazing, but because the US government and governments broadly speaking, need to debase the currency in order to get past this. How this ends up playing out is the Federal Reserve buy all these bonds, their balance sheet goes up to like 30 trillion. But just like your mortgage, let's say I take a mortgage out today over the next 30 years, that amortizes over 30 years. Slowly pay the coupon back for 30 years, and at the end of it, the mortgage disappears. It's what's called balance sheet runoff. And that's what's likely to happen with the Federal Reserve, and that's ultimately what happened from the 1940s into the 1980s. We've seen balance sheet runoff. Federal Reserve were able to deleverage because they were able to just hold tight while inflation increased at a faster pace than interest rates, meaning tax receipts increased at a faster pace than interest. It allowed the government to earn more money, pay down their debt, and delever. It takes a couple of decades, and that's ultimately how we get out of this. It is a soft landing, but everyone's so focused on the next 3 to 6 months, they're missing the bigger picture. And this is the only way I see out for the US. It's pretty straightforward. And there are certain politicians in the US actually talking about curve control already. So we're not, in my view, I don't think we're too far away from it. That's my view, essentially. There's a number of different sort of macro trends that are occurring at the moment. It's mainly surrounding the housing market. And this is really, really, really interesting. It's really interesting because everyone's looking for the consumer to tap out. We're going to go through consumer credit, the latest consumer credit reports. I think you guys are going to be surprised. It just surprises me that so few people, like all this data is free. It just requires a little bit of time to go and check it out. But nobody seems to want to go and do it. And so when you actually look at the data versus listen to sentiment, it's two different worlds, and it's kind of intoxicating to actually listen to. All the data is out there in the open. You just got to go and check it out and verify it. So house price forecasts. This is CoreLogic's data. House price forecasts. Currently, year over year, house prices in the United States are up 15.8%. That's down from over 20% a couple of months ago. Month over month, down 0.3. Year over year, up 15.8. It's a very unhealthy U.S. housing market. Prices are extremely high. The forecast moving forward for the next year is 3.8% growth relative to where we currently are. So there's the forecast right there over the next year. That's 3.8% growth from where we currently are. So it's already gone up 20%, and now we're expecting it to go up another roughly 3.8% over the next year. That's what the forecasts are. Very, very unhealthy market. So how do we have mortgage applications collapsing? How do we have all that stuff happening and house prices are still expected to rise? This is what a lot of people are missing about the real estate market. If we have a look at housing inventory, this is active listings for sale within the United States. This is currently what's on the market. It's down significantly from where we were back in 2017. we're still below pre-COVID levels of 1.3. We're more than 50% below in terms of inventory versus a normal market. And the problem with that is you don't have pricing power as a buyer. House prices continue to push higher. Yes, there's demand destruction. If there's 100 buyers, some of those are very wealthy, some of those are not very wealthy. And you've got a situation where there's only 20 houses. 80 of those buyers can disappear and there's still 20 of them left over to buy the houses. And that's what we're seeing. That's why you're seeing stable house prices, even though volumes are coming down. Previous cycles, what would have happened right now is the house price will come down sharply. And that is happening in certain areas. In certain areas like Boise, for argument's sake, it's not. It's in one of these datas. I got to go through all these datas. Anyway, we'll come back to it. We'll come back to it in a moment. Anyway, there's not enough houses built over the past decade. It's structurally underbuilt in the United States after the global financial crisis, about 4 million houses. And that's why we're in this situation where mortgage rates are now up at 6.11%. The demand declines, but we don't have enough houses, so house price remains quite elevated. It's a really unhealthy market, and we need to structurally build to get that supply back online, because millennials, there's 5 million millennials from the ages of 30 to 39 that just entered the 2020s. That's demand at prime age in terms of earnings growth, looking to buy a single family home, and we don't have enough. Housing is also a pretty good inflation hedge as well, because capital costs that go into it, and if the raw materials increase, which as of right now, they're coming down quite hard. We'll look at that in a moment. But if the raw materials increase, less houses are built, home prices remain quite elevated. So anyway, as of right now, very unhealthy situation in the US. Mortgage rates at 6.11%. It's been above 5.9% since June, right? So we've had elevated mortgages since June. We're now in September. So 3 months later, what we're seeing as of right now is that inventory is actually starting to roll over again. So this is Redfin's data. That black line there is 2022. Is it reloading? There it is. That's the new listings. Inventory starting to come down. That's actively listed. Year over year, it's down 16% versus 2021. We don't have enough houses. We need to build more houses. We need mortgage rates to stay higher for longer to keep demand away so it doesn't turn into a bubble, but we need more houses. It's structurally underbuilt by 4 million at a time where we're at a demand sweet spot. We're going to talk about credit in a moment because it's never been better, which is also adding to a little bit of the challenge. You've got prime age millennials with cash trying to buy houses at a time where there's not enough. And that's ultimately why we're seeing a very unhealthy situation where, as of right now, in the latest report, 15.8% year-on-year growth in home prices, even after 3 months of mortgage rates at above 5.9%. So what Redfin's data is telling us is inventory is rolling over already, which is absolutely insane when you think about it. So as you can see, the mortgage rate as of right now is 6.11%. It's up from 5.9% a week ago, and it was at 5.91% back in June, 17th of June. So we've gone sideways. We're pretty much flat for the past 3 months or so. So as of right now, mortgage rates, they're not going up. They're not really coming down. I'd argue that they are going to come down, meaning demand is going to start increasing. Home builders are a pretty good place to be. The reason why I'd argue interest rates will come down, let's check this out. This is the expected path for the Federal Reserve in terms of raising interest rates. We started coming up with the probability of a rate hike 29 years ago using the euro-dollar market. The probabilities are built by looking at the euro-dollar market, and that's based off of a number of different variables from economic data. We'll have a look at it right now. I'm going to close some of these windows because we'll have a look at it right now. So the inflation nowcast by Cleveland Fed. So inflation, essentially what they're looking at here is a number of different data points. This is forecasting the future expected inflation. And they're using Bureau of Labor Statistics. Again, that's structural inflation. They're using economic analysis, that's PMIs, etc., and energy, commodities, in order to determine what the forward inflation rate is. It is coming down. So we are going to see, I think, on the next CPI print, because the market's expecting 8.7%. And for August, Cleveland Fed are forecasting that it's going to be somewhere closer to 8.2 to 8.3. So that surprise will change the probabilities as well. But as of right now, we're looking at a peak for Fed funds in March of next year. between 3.75 and 4% for interest rates. And then from there, it slowly starts to decline into 2025. So if inflation is coming down, and I think it could fall like a rock, and the reason why I think it could fall like a rock is because one of the biggest issues for inflation was refined products. Those refined products included gasoline. Gasoline was up 106% right at the peak here, and that obviously led to headline inflation. It contributed to the 9.1% growth in headline inflation. Since its peak, it's down 45%. But more importantly, year over year, gasoline is, if you use that as a gauge for refined products, gasoline is only up 8% now from 106% a couple of months ago. It's not just gasoline. One of the main ingredients into building a house is lumber. Lumber is down year to date. It's down 56%. And year over year, it's down 26%. Why? Volumes of houses are coming down. The price isn't coming down, but the number of homes built is coming down. Again, we still got to talk about housing. So where we are as of right now, across the board, the only one that's really elevated is natural gas, which looks like it's getting ready to roll over. Crude oil, which is a raw material, just falling out of the bed as of right now. I think these are buying opportunities, but I think that there's a massive repricing going for whatever reason. It's also the same for food, soft commodities. So this ETF, DBA, has 24 different futures contracts from soft commodities, cattle, frozen orange juice, everything. So it gives you an idea of where agriculture and food is. It's coming off as well. Year to date, it's only up 3%. Year over year, it's only up 6%. It's come down quite a bit. Food's coming down, energy's coming down. And that ultimately is why these probabilities, where is it? Cleveland Fed. Oh, it's this one down here. We did have it open, actually. There it was there. That's ultimately why I think we're at 8.2 to 8.3%. Dominic has a question here. What is your methodology for turning over rocks? What are the first metrics you look at when deciding whether or not to investigate further? Okay, really important question, but I'm going to answer it a little bit later because what I'm trying to do is create the story of where the macro picture is. And what that does is it gives me an idea where the trend or flow of capital should go over the next number of years. Where do I want to focus my attention? A lot changed this year. So if we get this year right, not in terms of performance, but if we get it right in terms of the macro, we position ourselves well. The next couple of years is where the fruits of our labor gets paid off. And that's ultimately where I think we are as of right now. So I'm leaning towards the housing market because I'm going to explain a number of positions. I would say 30-40% of our portfolio is levered around the housing market, but lower risk essentially because there's certain companies where we don't actually need the marginal growth. We just need existing homes. So that's essentially what I'm moving towards at the moment, Dominic. So once I get through this, that's a great question, and then I'll take it from there. So as of right now, when we look at inflation's coming down. So this is only going to cause headwinds to the interest rate expectations as determined by the euro-dollar market. The reason why this is important is for 29 years, the Federal Reserve only ever went with the market, provided that the market expected a 60% chance or greater of an interest rate hike. That's really important. It's really, really important. And you can see that if you go back a couple of months ago, Jerome Powell came out and said no 75 basis point rate hikes. And what did he do 3 weeks later? He raised 75 basis points. Why? Because that's what the market expected. As of right now, the hawkish Fed versus the actions are very different. You've got the Fed funds rate at 2.25 to 2.5%, while inflation trailing 12 months is at 8.5%. Big disconnect, massive disconnect. They're staying well behind the curve. So I think moving forward, we're likely to see the Fed stay well behind the curve because it would be systemic, as we've seen here. It'd be very systemic for the US government. So what the Fed say, everyone on social media says, but Powell said this. Who cares? Powell follows the curve, and as of right now, the curve says, yes, there's going to be more rate hikes. Absolutely. We're going to get to 3.75 to 4%, but we already know where the neutral rate is at a time where there's going to be headwinds to this data. CPI is one of them where I think it'll come down quickly because of the commodity input. Gasoline, as an example, is down 45% off its highs, almost cut in half since June. Not many people are talking about that, but it's a crucial input cost for essentially discretionary spending. Consumers, back here when this got down to about 320, Gas Buddy were estimating that consumers were saving $250 million a day in the United States on gasoline. It's gone down probably equal proportions, about $500 million every day on gasoline prices. Where does that cash go? It's more disposable income for whatever spending it may be. But the main takeaway is an awful lot of these input prices from a commodity perspective are coming down heavily in the United States. It will impact the probability of rate hikes in the future. It's likely to roll over. These mortgage rates, I think, are going to soften up. And then again, house prices haven't come down. People are looking at areas like Boise and Idaho, where inventory spiked higher and saying, see, I told you there's a housing crash. That might be in Boise. But the United States broadly, 82% of homes are sold in less than 1 month. Not specific to Boise in Idaho, but broadly speaking across the United States, inventory is a major issue. Certain markets are going to be weak. Other markets are going to be a lot better. I thought I had I think I must have closed it. There was anyway, the top 5 markets that had a greater than 70% chance of, here it is here. Top 5 markets in the US where the probability of home price declines is greater than 70%. I guess that's Washington, Florida. I don't know. Is that Washington? Is that Nevada? Idaho, Boise City. But all of these are specific cities. There are going to be, individual anomalies. But broadly speaking, in the United States, there's a reason why home prices are still up year on year despite mortgage rates doubling. There's a reason why, and it's got to do with inventory at a time where you've got a hotbed of demand. So, so Tom, just on the, if you're asking same prices before the war, it's actually below. It's 12% below the war. Here's February 24th when the war started. It's 13% below the war. Anyway, getting back to the story, housing is very interesting to me because we're structurally underbuilt. Sentiment's incredibly negative. And some of the companies that we bought are just bizarrely cheap. So certain areas you want to focus on in the United States, areas in Houston, around Texas and Florida, there are certain markets in those different regions where it's a hotbed for growth. Population is growing drastically in both of those regions. Home prices are very elevated because you don't have enough supply. There's a company called MI Homes that we bought into. This is just an example of, going back to what Dominic asked, how many rocks do you turn over? Well, first and foremost, figure out where we are. Okay, so we have a situation where interest rates are probably going to be capped. That's favorable for interest rate sensitive assets. Not only that, but we have a challenge with inventory in the real estate market. There's not enough. So all of a sudden, anything surrounding homes, home building, home renovation, the number of homes up for renovation that are between 20 and 39 years of age is going from this year 20 million to 25 million. That's an increase of 25%, but that's a 5 million increase in the number of homes that are going to need renovation in the next 3 years. So around home building, renovation, all very interesting markets. MI Homes, as an example, very negative. People are looking at it saying it's a cyclical stock. We're at the peak of the cycle, and that's why it looks incredibly cheap and it's going to roll over. A lot of people are looking at inventory and they're saying we've got 11 months of inventory, but the mistake that they're making is they're adding in homes that are planned to be built and homes under construction. Home builders never bring homes to market. They actually sell them off the plans. They're all under contract. 10 of those 11 months is homes under contract. In order for us to have a terrible market scenario, you would need to see the cancellation rate spike 100%. It's not likely to happen. For the reasons that I mentioned a moment ago, 5 million millennials entered this decade in prime earning region, 30 years to 39 years of age, entering leadership roles, looking for single-family homes. It's a hotbed for demand, but demand is not what's driving the market right now. What's driving the market is supply, and then it's going to be enduring because of that demand. So MI Homes has a backlog of orders of 2.7 billion. It's currently priced at 1.1 billion, and the gross margin on that's 25%. So $634 million in gross profits just on their backlog of orders over the next 3 quarters is about 60% of their market cap. Not bloody bad. Clean balance sheet, but as well as that, look at the price, it's $41.46. The estimates for 2023 is $16.63 GAAP earnings. So $16, let's assume they only hit $10. Let's assume we do have to downgrade because volumes contract or whatever it may be. Even at $10, a 30% haircut on that EPS is their margin of safety. We're playing 4 times earnings. Pre-global financial crisis, the market was happy to pay about 8.5 times earnings for this company. Even if earnings got cut by 30% in a market environment that's fantastic for MI Homes, even if it got cut by 30%, you're still 50. You're still got 100% upside. That's a fantastic margin of safety. And the reason why that exists is simply because the market believes we're going to get a housing market crash. Certain markets will crash. but not every market's going to crash. And so the way in which I'm positioning the portfolio is to take advantage of these trends. Another way, I didn't necessarily just buy Overstock for its e-commerce business. They sell furniture. But Overstock, we'll talk about Overstock right now because I know a lot of people are going to talk about it and ask questions about it. I had to hold Cameco for 6 years to make a 25% compounded growth rate for 6 years. I was losing money down as much as 40% at one point after 4 years. So I had to hold on to it for 6 years. Why did I hold on to it? Fundamentals continue to improve. Well, let's look at Overstock. This is a business that if we have a look at the financials, and we have a look at it on a quarterly basis this year, all other competitors got wiped out in terms of cash flow. This is a very profitable business, and what I really liked about it was you can see revenues cut in half, and they're still profitable. So the systemic risk when you got 440 million in the bank is very low. And then you have the call option on Medici Ventures, which I'll talk about in just a moment. But if you look at the quarterly earnings here in the cash flow statement, are we in cash flow? No. Let's have a look at cash flow statement. We had $33 million in terms of positive cash flow last year, or at the beginning of the year. That's in Q1, 33 million. And then we had 10 million in accounts payable, which was drawn down. We done 7 million in net income, but there was a couple of one-off expenses here. So the company is profitable on the year. And as well as that, they made an investment into T0 of 10 million in a year where it's supposed to be massive turmoil. As well as that, they've been buying back some stock, not a huge amount, but $35 million. And they've got a very clean balance sheet. But why am I talking about Overstock? They sell furniture at a time when the number of houses that are up for remodeling is about to increase 25%. So that business itself is profitable in a really bad market environment right now with interest rates doubling and a readjustment to demand. But at the same time, it's got massive tailwinds. It's profitable, enduring balance sheet. Now let's talk about T0. What happened to the fundamentals there? They were doubling their volume year in, year out prior to ICE markets. Then you had ICE markets invest in the business. I don't know how much they invested in the business. What I do know is in Q1, Overstock invested another 10 million, but their ownership in the company went from 84% up around there, all the way down to 55 to 60%. There's speculation that's at a $20 billion valuation. I don't know. I have no idea. And I don't really care, to be honest. When ICE Markets came on board, the founder of ICE Markets from 30 years ago and the CSO came on as CEO, they've made big investments. They brought over a world-class team to scale a business that was already growing 100% in volume year on year. And the comments from management are saying that the nature of this business, it has the potential to be bigger than ICE Markets. ICE Markets is a $65 billion business. How is it going to be bigger? Well, what does T0 do? They bring liquidity to private markets. If I want to do a real estate syndication, I can sell in the aftermarkets tokens on my real estate investment. So hedge funds, for argument's sake, if I invested in a hedge fund, I got to redeem that, send it in a letter. It takes a couple of months. I got to trade out and then whatever. What T0 are doing is bringing liquidity to hedge funds, to real estate markets and real estate syndication funds, private equity, as well as public markets. It opens up like hundreds of billions of dollars in volume that didn't previously exist, where there's an aftermarket. If I want to invest in, I don't know, Horowitz and whatever you call them, venture capital fund, I can do that in the secondary market without approaching the company through the liquidity of T0's ATS. And so the fundamentals of the business are incredible because they're the first company that's obviously SEC regulated, but also opens us up a massive private market with the best high-grade human capital in the market. Who better to do it than the founder, the CTO and founder of ICE Markets and the CSO for the last 3 decades. So the fundamentals have gotten better. It's a profitable business in a downturn. They're able to reinvest and buy back stock, and they've got a massive tailwind. I don't care about what share price is doing right now. I want to position myself for the next couple of years, and I think Overstock is just a fabulous business. So my conviction only gets stronger the share price goes down, but it's not unfamiliar territory. And here's the thing. That's why I advocate for diversification. I can only speak about Cameco simply because I have a video explaining my thesis from April 2017, which was right here. And I can explain that exactly what my thought process was back then. And in short, it's exactly what everyone's talking about today. The problem with wind and solar, and I did invest in solar back then, is baseload energy. There's no baseload energy. We don't have battery technology. We don't have that today. Outside of subsidies, those markets don't do very well. Uranium is baseload, supply deficient. The problem was public policy. I was wrong on that because I didn't understand the demand aspects. After Fukushima, you started to see a phase out in Germany, a phase out in Belgium. You started to see the phase out across Europe, and that was impacting the price. And that's where I kind of went wrong. But I did ultimately think it was going to play out eventually. Am I concerned about dilution of Overstock's ownership of T0 via additional funding rounds? Overstock, I believe, have T0 have $250 million in the bank. So I think the next one would be a public offering, which they'll probably raise money through a sale. As of right now, we own 55 to 60%. If you look at FTX, its IPO presumed value is $15 to $20 billion. Right now, Overstock is trading at less than $1 billion, its equity price. It's got its enterprise value. It's got $445 million in the bank. And we're talking about, 55% ownership in a business that I think will be 10, 15, maybe even 20 billion in the next 5 years as it scales. So yes, it's part of scaling a business, but you're raising money to reinvest for growth into the future. And I can tell you one thing, T0 are not wasting money because they've got the backing of ICE Markets, which is where a lot of that volume is coming from. For context, ICE Markets is the parent company of the New York Stock Exchange, very well-connected company. So an awful lot of the volume is going to come through that significant investment that they made into the company. So I'm not worried about it at all because it's going to grow out value. If I have $1 and I make 20 cents, okay, I've made 20%. If I raised $1 and I sold half my business, I've got $2. I own 50% of the company, but the marginal growth may not be 20 cents. It might be 60 cents. The value of my share is more than what it was previously, if that makes sense. And so you got to think about it. What are they doing with the cash that they raised? Developing out their business. They have the tech, they have the SEC regulation, they have high-grade human capital at a time where, regulations, the foot's coming down from the SEC. It's a perfect market environment. As well as that, there's 20 other companies. We don't talk about Grain Chain. Grain Chain it's another company that solves supply chain issues for the agricultural industry. We own a piece of that. We own 17.5% of that. Like, you got to think about it. If that's sold for, let's say, $200 million in 5 years, we get $35 million. We get $35 million. That's us as Overstock in the bank on a market cap of 1.2 billion. It doesn't seem like a lot, but 35 million times 20 different businesses, all of a sudden you get 100% on the upside if all we got was 35 million. And so there's a huge amount of opportunity in that Medici Ventures portfolio. Big Global, I think, is another 10, 15, $20 billion business. It just takes time. And it's just going to take some time. So anyway, the main takeaway is there is a thriving business with massive tailwinds. That's why I'm talking about Overstock. So I think that their furniture business, online furniture business, it's profitable because of the nature of it. It's a drop shipping type business. They don't have any logistics infrastructure. They don't have any stores. They don't have any inventory, nothing. They're connecting a customer with a mom and pop store and they're allowing for the transaction. That's why their margins are 5%, but it's profitable in every market environment. And that's the beauty of Overstock. There's no real systemic risk there. And we generate cash consistently while we wait for Medici's to re-rate or come public or whatever it may be. So that's the beauty of that business. As well as that, we recently bought into Builders for Swords. Builders for Swords, really, really, really interesting company. These guys are a leader in their space. Framing of a home. Think about all the lumber and the framing of the home. These guys build that. We have a lot of labor constraints. I'm going to get to all these questions. Holy smokes, there's a lot there. A lot of labor constraints as of right now within the construction market specifically. And ultimately, that challenges an opportunity for a company like Builders for Swords. Why? Well, they pre-hang doors, for argument's sake. They do an awful lot of on-site manufacturing in-house, and they sell the frame. And instead of it taking a couple of weeks to put the frame up, it takes a couple of days. So the on-site time to build a frame is only a couple of days now with Builders for Swords. They bought a tech company last year for 450 million. Then they bought Apollo as well for 4.5 million to improve that tech stack. That's essentially helping their customers essentially save money, bring down the costs of production. And that's at $1 billion run rate already in revenue. All that aside, what do we pay for this? The reason why it's very cheap, we're paying about 7.5 times next year's GAAP earnings. The reason why it's so cheap is simply because of sentiment and expectations for a housing market crash and volumes to decline. As I mentioned before, I think the odds are very good to be contrarian in this space. And I think over a 3-year time horizon, this is going to pay out huge. Obviously, I've got some technical analysis there as well. But anyway, that aside, I think from a fundamental perspective, it's pretty good quality. So we have a number of these type plays where it's really centered around the house. The eToro company is a little bit different. We'll look at that in just a second. Lennox International sells HVAC systems. So Lennox International is selling air conditioning. They're selling heating systems, ventilation, that type of stuff. Market leader, only really 5 players, pricing power, strong return on invested capital long term. They had challenges with a tornado ripping through their facilities that brought the valuation down massively, and we were able to go in and scoop up some cheap shares. This is a company I bought instead of Zillow, and so far the biggest mistake I made is not making it a bigger position. The eToro company is, these are all non-discretionary spends. So going back here and just talking about like what we're looking for, we want to be invested in equities, but not just any equity. We want to be invested in a company that's at a reasonably cheap price. We want to be invested in a company that has pricing power, right? So if you look at HVAC systems, if we're in a recession and your boiler breaks down and it's minus 10 degrees Celsius outside, are you going to replace your boiler? Of course you are. Of course you are. Otherwise, you're going to freeze to death. Air conditioning. If it's 40 degrees Celsius outside, your air conditioning system breaks down, are you going to replace it? Absolutely. Lennox International, 80% of the revenue comes from replacement units. At the same time, the beauty about that business is it's a growth industry without the housing sector, because work from home means that the units are working longer. So the replacement time is actually shorter. They break down a lot quicker because they're used a lot more. So HVAC systems, it's in a growth cycle. Extreme weather conditions is leading to more demand for ventilation systems, more demand for aircon, more demand for heating systems. And so you have this perfect storm where you actually don't need the housing market to grow. But if it does, at the margin, you make way more money. But if it doesn't, you still make a lot of money. Beautiful, beautiful, beautiful company. In the near term, it worked right away. It doesn't always work that way, but sometimes it does. The eToro company. So let's just talk here. So everyone's expecting the world to melt down. It's not the case. Fundamentals are actually quite strong. We're going to look at the consumer actually right away, and then I'm going to get to all these questions because there's a lot there. Latest quarter, I think since Q4 last year, everyone's been telling me we're in a recession, earnings are going to collapse. We're in a recession, earnings are going to collapse. I think I've heard that from just about everyone now every quarter. Latest quarter, I was a little bit nervous, thinking that maybe this is the quarter we're going to slow down. Well, FactSet is a pretty big company, $16 billion analytics company. And throughout the earnings season, they give us all this information about how companies performed. S&P 500 revenue above, in line, below estimates. Year-on-year revenue growth. S&P 500 broadly 70% above expectations on the latest quarter. That's above its 5-year average of 69%. Revenue grew at a little bit faster pace. When we have a look at earnings, so if you look at earnings, 3 sectors, so you're looking at these blue bars, 3 sectors were negative. That's out of 11 different S&P 500 sectors. So 3 were negative, and then the other 8 were positive. Energy is an anomaly. It's actually not a huge contributor. It's only 3% of the index, but that was up 300%. Outside of that, you still have growth across other different sectors. For earnings, where margins are a bit of a problem, 75% of the index actually beat earnings. It's slightly below what the average, I think, was 77%. Whereas, say, the average, where did I see it? Overall, 87% of companies in the S&P 500 reported actual results. Okay, so there's still a couple to report, but more or less all of it. So it's slightly below. It's 2 points below the average 5-year of 77%. What I'm trying to say is everyone's been predicting doom, and it actually hasn't played out, and it's still not playing out. And the reason being is the problem is actually the government, not the housing sector. So let's pop on over here and let's have a look at, not this, let's have a look at household credit. I don't know if you guys read these reports. Federal Reserve report them anyway. This is August. This is the latest data. And just to give you a little bit of perspective, this is for Q2. Let's have a look at the 2-year bond yield, just because there is going to be a couple of conspiracies to say that interest rates are way higher. Let's have a look at this on a 3-month basis, on a quarterly basis. So let's have a look at this here. So this is from 2.35% on the 2-year up to 2.9%. But what's important is this here has a tail. So we actually peaked in the last quarter. We've only just started the 3rd quarter. If you go into the daily chart, you'll see that we've kind of gone sideways with interest rates. It peaked in June and then it rolled over. We've kind of gone sideways. So this here is a fair reflection of after interest rates pushed higher, what consumer credit actually looks like. This is really important because there's a lot of, I say misinformation because this is factual data, but when I hear someone speak about their sort of sentiments, it's very different to what the data is suggesting. I'd like to follow the data personally. I wouldn't like to make a guess on this stuff because bigger picture, I'll either be right or I'll be wrong. And I can be wrong in the near term for sure. I'm certainly wrong right now. I'm getting my butt kicked. But I think in the long term, we'll be perfectly fine. Most of the debt is mortgages. As you can see here, auto loans, not really growing much. Really important. Everyone thinks it's the auto market's massively in decline. Let's pop down here. Mortgage originations by credit score. This is really important. So again, we already know that supply is really tight for the real estate market. Demand is a hotbed, but it's not driving price right now. It is actually coming down because of higher rates. But look at the credit quality. During the global financial crisis, credit quality was trash. It was absolute trash. So as you can see here, the blue is FICO scores greater than 760, right? So anything above 700 is fantastic. The average is 711 as of right now, as of the latest data. But anything that's blue is incredible. Dark gray is pretty good. And anything below there is not that great. Look at the difference between where we are today versus pre-COVID. Most of the loan originations for mortgages is 760 or greater FICO scores. Loan credit and originations are incredible. That's really important because we're going to look at delinquency rates in a moment. You guys will see something very interesting. So as you can see, there was a lot of people that had less than 620. All of these were going bankrupt. All of them were going bankrupt. Almost doesn't exist today. Almost doesn't exist. All of those loans there were pretty much going bankrupt. You had about, I don't know, 75 billion, $100 billion in pretty much bankruptcy loans, essentially. Credit quality today is much better. If we go down a little bit lower here, so that's the auto market loan origination. A little bit worse here, FICO scores worse. But the amount of credit going into the auto market hasn't grown. And it's a much smaller market. We'll talk about that a little bit later again. HELOC balances versus credit card balances. Credit cards have increased marginally, right? So HELOC balances is home equity line of credit versus their limits. So home equity loans could double. Credit card loans could go up about 4x as of right now based on their limits. There's plenty of room to see expansion in terms of credit. And you've seen a moment ago that the FICO scores are pretty darn good for the mortgage market, and mortgage market's the most important. If we go back up to the top here, those orange bars are mortgages. You really want good quality credit there. Otherwise, it's a house of cards like what we've seen back in 2006, 7, and 8. Really terrible credit, and yeah, it didn't play out very well. Let's go down here. Let's just skip along here because there's a lot of stuff in here. You guys can read this if you guys want. It's on the New York Fed. Delinquencies, number of consumers with new foreclosures and bankruptcies. Just in case you guys can't see it, let's zoom all the way in here. There it is there. That's it there. So a lot of people are talking about bankruptcies and foreclosures because of higher interest rates. That's it there. Look at where we were in global financial crisis. It's day and night. It really is day and night today versus pre-COVID. And you can see here something happened during COVID. This is what happened. Fiscal stimulus, $7 trillion was pumped in. Look at the savings. This is incredible. Look at these savings. Top 80%, savings were at least 200% higher. At least 200% higher. Bottom 20%, unfortunately, are getting absolutely rinsed, down 20%. But these guys are not, they don't add to aggregate demand. This is top 80%. It's in fact top 60%. But you can see that savings have massively increased. That loan stock, here's a comment here from Moynihan on the latest earnings report from Bank of America. The account balances of consumers pre-pandemic to now are multiples bigger. The idea that they spent the pre-pandemic money that came in January, March last year is just not true. In the first 2 weeks of May, the consumer spent 10% more than they did last May. This guy's the CEO of Bank of America. Latest earnings report, that's essentially what he said. Consumers are in great shape. I don't know where this notion came from, but this is the latest data that came out like a week or two ago. It's day and night relative to where we currently are. And you can see that an awful lot of the debt is in working age population from 30 to 59. Most of the debt's between those. We're at a point where the labor market's quite tight. Wage pressures are quite high. That's structural. It's going to remain that way. You know, credit scores are going to stay low for quite some time. Auto loans is only a small portion of debt. It really is. And I'd say probably the reason why you're seeing those FICO scores lower for auto loans is because more of the debt is in 18 to 29. You've got to use your credit card more often, build up that score. The younger you are, the worse your credit score, but over time you build it up. Anyway, consumers in great shape. Consumers in great shape. Delinquencies are picking up, but very slowly. And the deception is that people are looking at it year over year. And if you look at it not year over year, but actual nominal number, this is in billions of dollars. Sorry, this is in thousands. So I guess this is numbers. It's like, I don't know, I don't know what that is. Is that like a million? I don't know. It's very small anyway. Relative year over year, yes, it's up like 600%, and that might sound scary, but it's not systemic. Consumers in great shape. Housing market is very, very, very undersupplied in terms of the number of houses. It's a hotbed for demand. If interest rates come down, you will see a bubble in the housing market. So that's going to be a challenge, and the consumer has plenty of room to spend. Then it comes back to the macro of what happens then with interest rates, and I don't think there's much room to allow this to continue pushing higher. I do think that if we got any higher, which I don't think we are, I think you can already see the market's starting to show us where the peak is. Where is that? There it is there. The market's already pricing in, March to June next year as a potential peak. So going back to houses, home builders, let's just have a look at this here. They're in the consumer durable industry. So let's just have a look at the consumer durable industry over the last 10 years. Zoom in here. Can you guys see that? Is my face in the way? Okay, there it is. Consumer durables. So where we are as of right now, the price to earnings ratio for consumer durables is 6.5% or 6.4 times. The average over the last 10 years is 17.9 times. So we're way below the average. We could go up over 100% and we'd still not be back at the average multiple. Why is that the case? Well, if you actually look at earnings are up 656%. That's that green line. And the red line there is market cap of all the companies within the consumer discretionary space. It's only up 155%. So the value of these businesses are going up at a much slower pace than earnings. And that's been the case now for 10 years. Not for 10 years, excuse me. That's been the case now since late 2021. This is all contraction in terms of multiple. What we're seeing right now is a valuation contraction. We're trying to find out where the neutral rate is, what the discount rate is, and what we should pay for these stocks. I think that there's a cap on the upside in terms of the amount of interest rate hikes we can actually go. So I find this incredibly attractive. I think if you've got a couple year time horizon right now, it's incredibly attractive. Inside this, you've got home builders and all that sort of stuff. Over the past 3 years, average multiple has been 12.7, lower than the 10-year average. And it takes out that anomaly of COVID. Does it? Where was that anomaly? What date? 2018. So it takes out that anomaly of 2018. So as of right now, when we're looking at this, the average was 12. Let's assume 12 is fair. You could still rally about 100% to get back to fair value. And again, as you can see here, since pre-COVID 2019, over the past 3 years, consumer durables are only up 7%. Earnings are up 148%. Now, if Peter Lynch is right, even if he's only half right, that the expected long-term return of a stock is equal to its potential earnings, well, these stocks are massively undervalued with a huge tailwind. And that's sort of how I'm looking at it. And that's how I'm positioned. So it might look ugly right now, but over the next couple of years, I think it'll be fine. Okay, there's a lot of questions here. So let's rip through some of these. Thanks for sharing your time. You're very welcome. You're very welcome. Patrick had a question. Good. I hope I answered your question, Dominic. If I didn't, shoot me another message. The methodology is, what's the macro trend? Where do I want to invest? If you look at the portfolio, a lot of the businesses in the portfolio are centered around home building, consumers. Consumers are in good shape. They might scale back on their spending in the near term, but these companies are dirt cheap. And actually, before you get into it, I just want to talk about Tupperware. Tupperware was down 30% yesterday. And this is why, like, going back to Cameco and understanding the fundamentals, which gives you a little bit more conviction to stay in the company longer term. What changed for Tupperware? Absolutely nothing. You get some of these scummy reports all the time, and you need to be able to see through it. So I think this is straight up fraud. I could be very wrong, but this looks like straight up fraud to me. StreetInsider.com, yesterday they changed it. They updated it a couple hours before the close. But this is what they said. Last week, Tupperware made some headcount reductions, an industry source relayed to StreetInsider.com. They cut out internal investor relations, and it was told to me that the CFO said she didn't think the company would be having that much dialogue with investors in the coming months. Sounds like a pretty shitty thing for Tupperware's management to say to their investors who are financing operations. So that kind of bothered me. Didn't know if it was true. Could have been speculation. Share price drops 31%, 33% yesterday. I haven't gotten any indication from management to say that this company, anything has changed. After the market closed yesterday, this is why I think this is probably like a fraudulent type article. After the market closed, there was an investor release, and I think they released it because of this trash. But they released this here on the 6th of September after the market closed. Tupperware names Douglas Lane as Vice President of Investor Relations and Strategy. So here they're saying that investor relations are not really going to be communicating with investors in the coming months. And then after market close, they hire a vice president of investor relations. Something's fishy there. This line here really drew me in to stick with the company. And sometimes we're going to get this. It's going to be very important for us just to be patient with this. Our average cost is $9. We're down maybe like, I don't know, 4%. Something. I don't know what. It's not much. We've already rebalanced the position, so it's not really a big deal. But the fundamentals haven't changed. And just because it was down 33% doesn't mean that you automatically sell it. So this is what they said. We're pleased to have Douglas join us as we begin to see our omnichannel strategy come to life as a key component to our turnaround strategy. That does not tell me that there's challenges going on inside. Last earnings report, Fernandez came out and said, we're encouraged by the improvements that we've seen. If you have a look at insider buying, look at all the buys. They didn't sell a single share, but they bought a couple of $1 million worth of stock down around $6. That's what prompted us to increase our position size. Company was cheap. The turnaround is very simple. Sell non-core assets, pay down debt, buy back stock, pivot to digital, expand your margins, grow. Very simple to understand. Really, really simple to understand. But a turnaround with high inflation, labor constraints is really challenging. These guys backing themselves with several $1 million, that prompted me to add to it as well. We had a small position. I brought it a little bit higher, got our average cost down. And it made all the difference. Yesterday, it was down 33%. Today, it's up 16% after that news release. There's going to be a little bit of concern, obviously, in the near term. But it's just these sort of tactics. I don't know whether there's any truth in that or not, but it seems totally made up that massively hit the share price. Really frustrating. And it happens all the time. Diversification. That's why you need a little bit of time and leeway. Stay diversified, and it gives you a little bit more time. And that's ultimately what I plan on doing. I don't like to make rash decisions. It doesn't make any sense. Was there anything else I wanted to touch on? I see a question here from somebody asking about Transocean. So I'm going to skip to the Transocean question. Rig has a backlog and day rate has been increasing. Absolutely. So I would have added Transocean to the portfolio. I bought Transocean. Is this on log scale? In May of 2020, and I still own it today. I couldn't buy it on eToro because the button was froze. If you don't believe me, you can ask eToro. I'm sure they'll tell you it was frozen. And it was frozen all the way back up to the highs here, which is kind of frustrating. I was down 50% on this at one point. And then the reason why I don't want to mess around with it is because the gains tend to come at a very short period of time. So when we're looking at this, it hasn't done anything, literally nothing, since January 2021. That's a year and 9 months ago. But the fundamentals continue to improve. There's no reason to sell it. It's massively under earning. It's got huge torque. It's massively under earning. These guys could be producing ridiculous amounts of cash flow, which will allow them to delever in a very short period of time. Backlog, since they started announcing the backlog, is up 1.3 billion. But more importantly, they forecasted 464,000 day rates on average for 2024. And because of what happened geopolitically, what's happening with Russia, and certainly the change of government in the UK, Liz Truss is talking about offering 130 licenses in the North Sea. That's all going to benefit Transocean. Look at day rates. This is only a small one, $20 million, $395. But this is a 14-month contract, that 440,000 day rate with add-ons of 40,000. That's $460,000. Or $480,000 for 1.5 years, 161 million added to the backlog. Fundamentals are better than what I was anticipating in 2024. Price hasn't caught on yet. So it's really important. Expectations are very important. I think this is worth more than $20. It's just getting cheaper and cheaper and cheaper as the backlog grows, as the fundamentals continue to improve. Offshore is growing at 15% year on year. Onshore is flat, for context. Why is offshore growing? Well, offshore it doesn't have the risk of, it's in international waters. You don't have geopolitical risks. People like Biden canceling. Gulf of Mexico is adding up a couple of new contracts. Brazil, there's a number of places that are hotbeds of fantastic growth. Transocean is knocking it out of the park. It may not be reflected in the share price today, and this is always subject to a massive, analyst hit pieces. That's ultimately what happened here. They said the company wouldn't be able to refinance, grow its day rates, or longer durations. 2 weeks later, they reported a refinancing 3 years out. They reported higher day rates, and the duration grew by 2 months. And so these analysts, I don't think they fully understand the company, but fundamentals continue to improve. May not be reflected in the share price, but this is a massively undervalued company. For right on the fundamentals, this is asymmetric bet in my view. So yeah, I just wanted to share that. This is from the 6th. This is from yesterday as well. continue to get this good news. Day rates up 480,000. It's just a matter of being patient. Okay, so Tom, what do I think curve control does to the dollar? I just checked dollar yen. Yeah, okay, so they've been doing it for a while. Inflation picks up, you continue your quantitative easing, your currency goes to shit. That's essentially what happened to Japan. But if Japan are doing curve control and Europe are talking about a bailout of energy of 1.5 trillion euros, and then you get curve control in the United States, everyone's easing. Everyone's getting debased. So valuations can be a little bit higher. And that's ultimately what I think happens. Valuations will be quite elevated for strong, durable businesses. But in the near term, I think it's also important to note that that wasn't very obvious back in the 1940s either. We continued to drop in 1940 when inflation picked up. And then it was only after that that equity prices started to push higher. But I think there's huge opportunity here in a world with curve control. What does it do to the dollar? If the dollar could be replaced, it would be probably the renminbi. But the renminbi it's not a good currency. There's no transparency there. There's an onshore and an offshore currency. And you got to ask yourself, why would Apple sell their goods and services in a currency that has no transparency? They wouldn't do it. And so everyone has the same problem with debt levels. So the dollar it'll probably come down against certain regions in emerging markets that have an awful lot of resources, but it'll probably stay elevated against places like Europe. Europe don't have those. They could have those resources if they wanted, but they don't want to frack and they don't want to do these different things. Fundamentals aren't improving for overstock, though. They're deteriorating. Disagree. Aren't you concerned of further dilution? Fundamentals are 100% improving. If you're looking at free cash flow, it shows it's a stable business. If you're looking at T0, it's not a speculative business anymore. They've got over $250 million in funding. It's probably a bigger valuation than overstock itself. And they have the cash to see it through. Fundamentals are improving. I would say as of right now, T0 is worth more than overstock alone. So fundamentals are improving. You have to look at the entire value. Grain Chain just got best tech stock on using blockchain for supply chain issues related to agriculture. These are real world applications. You also have another one. There's a social network in there that's scaling pretty quickly. I can't think of the name of it right now, but there's a number of these little businesses that could go to zero, but they may not. You might get 20, 30, 40 million dollars on an IPO or some sort of buyout or something like that. There's plenty of opportunity there in those smaller businesses. I just haven't looked into them. I just think that T0 and Big Global are the best opportunities. Whole sector has been deteriorating, but more like, yeah, I mean, it's still profitable. In the first 2 quarters, Wayfair burned $700 million. Bed Bath & Beyond is looking to go bankrupt. I actually made a comment on Bed Bath & Beyond, not on Bed Bath & Beyond, but I made a comment on my YouTube channel, which is another reason why I kind of took a step back. I think, have enough experience to know that you can be wrong on an idea and still make a lot of money. Bed Bath & Beyond is a company that I owned. And I owned it for the same reason I owned Tupperware. They were selling off non-core assets, paying down debt, buying back shares, pivoting online. But it wasn't pure speculation. It wasn't pure speculation because they had already scaled up their online business to 16% of the revenue and it was growing faster. EBITDA would continue to grow at a faster pace. Now, I bought it at $19 and then you had that short squeeze and it rallies all the way up to $46. I make 130%. Am I right on the company or am I wrong? I made it was over $40, which is what I thought it was worth. And I sold it for 46. I made 130 something percent. Was I right or was I wrong? I was dead wrong. They just hired bankruptcy lawyers. They weren't successful in the turnaround. You can make money being wrong as well. In the case of overstocks, like the inverse of that, company is solid. There's no risk of bankruptcy. In order for a company to go bankrupt, they need to default on their debt. Company has $442,600,000 in the balance sheet with 30, where is it? With $36.25 million in debt. Can't go bankrupt, right? So there's no bankruptcy risk there. And so you can make money and you can be wrong. And you can lose money and be right. And certainly with Cameco, I was right on Cameco, but I was losing money for a long time. 4 years. So 4 years is a long bloody time too. So yeah, I mean, with T0, I think, or with Overstock, it's a solid business. I think it'll be fine. Patrick's asking in regard to home builders, would not the material providers do well? Something like an Eagle Materials, for argument's sake. Net margins is 20% range compared to most home builders at around 10%. So what I like about MI Homes is they already have a backlog of 2.7 billion. Most of those homes are under contract. and there's a crap ton of leverage. They only own 50% of their land, and the other 50% they have an option on. They're one of the most levered plays where the balance sheet's not at risk. So you got a clean balance sheet, 50% ownership of land, and then you got 50% option to buy more land. You don't have to put the money down yet. You've got pre-orders on a number of houses. I don't know what the exact number is, but it's $2.7 billion in their backlog, and they're all under contract. So for me, it's like 60% gross profits over the next 10 months, and then we'll see where we go from there. But the industry is still structurally under earning, in my view. A lot of people might say it's over earning, but we just underbuilt for 10 years, and now I think you're starting to see that re-rating. So I actually think that home builders are looking very attractive. With regards to materials, I mean, Builders for Source is in that play, and these guys are really dominant, really dominant. You also have the option on the tech stack that they bought for total tech companies they bought 454,500,000, and it's already almost at $1 billion run rate. It's a really interesting company, and I think it'll continue to do very well. They've got a very unique deal with their suppliers. So if you remember when lumber was in tight supply, there was only one company that was actually getting supply of lumber, and it was Builders for Source because of the relationship that they have. They're buying it at fixed rates. So because lumber was very high, what was happening to Builders for Source? Margins were blowing out. Companies buying back shares as well, which is pretty good capital allocation when your share price is 7.5 times gap earnings. That's sort of what my view would be. Yale Telly, I just don't understand why you picked Alcoa. Aluminium not looking strong, an energy crisis killing this high energy usage. So aluminium prices may not be pushing higher, but where's aluminium inventory? It's down 24.5% over the past 3 months. Where is that inventory coming from? It's coming from companies like Alcoa. So why is Alcoa down? Well, they just shut down one and three refineries out in Norway. They shut down a refinery here in Spain. Supply is coming offline. Well, we don't have enough inventory. It's down 24.5%. This industry is not discretionary. Some of it is staple, like for argument's sake, aluminium foil in your house. Some of it's you listen to Boeing, they're going to be building new aircrafts that needs a hell of a lot of aluminium. In order to transfer energy over long distances, we don't use copper, we use aluminium. And so the demand is going to start improving over the next couple of years, but supply is down 24.5%. So I'm not sure what you're saying that's negative for aluminium other than the price. But price can be a liar at times, and I think it's a liar as of right now. Off the lows since we bought it, I think it was up as much as 30-odd%. It's not an expensive business. Earnings will probably be downgraded in the near term because they took those refineries offline. But what will happen is aluminium price will push higher on a lower supply. Margins will increase. And then despite higher energy prices, which is what brought those refineries offline, the higher aluminium price will normalize the margins. So they've committed to bring back their refinery in Spain back online by Q1 next year. So electricity prices in Spain are not going crazy. You're already seeing across Europe, it's coming down quite aggressively. If we have a look at Germany as an example, if we go DEB and we have a look 1 year out where electricity prices are likely to be, let's see where it is. I mean, we're down. Okay, it's bounced a little bit, but we're still down off those highs, 41%. Still pretty darn elevated. But this is looking like a bloody crash. We'll see what happens. I don't know what's causing it, so I won't be able to answer that question if you ask. But anyway, energy prices are coming down in Spain, which is in Spain and across Europe as of right now, which is kind of interesting. So energy comes down, aluminium goes up because of tight supply. What happens to Alcoa? I think it's going to do very well. I think it's going to do really, really, really well. So I think if you look at the bigger picture rather than the company specific, all of these producers, you have to understand that the opportunity that exists in all of these companies is the marginal change in the underlying commodity, not in the operational capacity of the business. If there's a $1 incremental change in, for argument's sake, crude oil, that's $1 extra free cash flow for the company producing it because they have cash costs that are fixed. So you have to have a view on the underlying commodity and not necessarily on the specific company. They need to be good operators. Why did I choose Alcoa? Vertically integrated. Okay, so if refinery is too expensive to refine product, just focus on mining bauxite right now, which might be lower. So you still make the money on the bauxite, but you hold off on the refinery. When we start to see high prices, the refinery is going to pay back out. So you constantly have a more flattened out curve because it's vertically integrated. Not every company has that opportunity. So I chose it because it's vertically integrated. But yeah, aluminium prices will have to react because supply is tightening up. And you just seen the U.S. government just bought, was it 375 new fighter jets off Lockheed Martin? That all needs aluminium. Boeing are talking about increasing the number of output for a new plane. Needs aluminium. Kitchen foil is very stable in terms of demand. Long distance energy transportation. How are we going to transport that energy? Aluminium wire, possibly. So there's a lot of potential growth areas. See where it's trading. Yeah, it's down as of right now, but look at where Alcoa is. It's actually diverging, which is kind of very interesting. But I think as of right now, this will sort itself out. It's always going to be challenges. When I bought, we used to own ExxonMobil. When we bought ExxonMobil, I sold it way too early. It is what it is. But we bought ExxonMobil right here on the lows. And if you want to go back to that period and have a look at the company, they were borrowing money in order to pay back debt. Why was it a good opportunity? It wasn't because the company was great, but it was because capital expenditure was about to collapse for crude oil. It just went negative in May of 2020. So capital expenditure is about to collapse, supply come offline. What happens to crude oil price? Well, in hindsight, we can say to push higher. It's just basic supply-demand economics. And so even though they were borrowing money to pay their dividend, it was only a matter of time before they would be in a situation where they would actually be able to generate ridiculous cash flow, buy back stock, and maybe increase dividends and whatnot. So yeah, I mean, it's really about the underlying asset, and it's sort of less about the individual company. Just don't understand what else. So that's the question there a second ago. Oil market seems to no longer have rational poles. Availability decreases and demand increases. Big energy crisis in EU, which will spill over into the USA. Can transocean be advantageous in this context? Well, there's nothing slowing down in the offshore market. What's happening right now is, I can understand like supply right now, and this has partly got to do with political games, but there's 1 million barrels coming online every single day from the SPR right into midterms. That's not going to last forever. Oil will recover. This is finite. It's like having a can of Coca-Cola. Eventually, you're going to run out if you drink it all. And so there's 1 million coming out of SPR every day into midterms. Get the prices down. It's political games. That's eventually going to end. So we've got a gap then in terms of supply, in terms of 1 million barrels. At the margin, what we've seen is Permian Basin's actually come on. Supply coming out of the Permian Basin, I think it's up 2 million barrels since 2020. So supply has been coming online at a slightly slower pace. Demand in Europe is down 11%. Just because prices are higher doesn't mean demand's very high. There's no supply. That's why prices are higher. So demand is actually lower 11% year on year in Europe because they can't get energy. That's the problem. Or we can't get energy. I live in Europe. So that's what the problem is. The lower the price goes, the less incentive there is to increase capital expenditure, at least onshore, and that's not what we're saying. So eventually you're going to see the SPR roll back. Europe, I think, will resolve itself. They'll have to either increase their production. Liz Truss, I think, is granting 130 new licenses in the North Sea. You need rigs for that. Germany were offered by ExxonMobil to do fracking. They're probably going to turn it down. We'll see. We'll see how much pain there is, but there is options in Europe for energy. But it would require a company like, Helmerich and Payne renting out rigs. I don't know if they rent them internationally, but onshore rigs. It would require, Transocean to rent offshore rigs, and that market's very thin. No capital expenditure really came online for offshore drillers because it was in structural decline. And so you've got a really young fleet that ExxonMobil own at the perfect time where no capital expenditure to bring on new drill ships has actually existed. So you're actually seeing a high utilization rate already. I think the energy market's in structural bull market, but in the near term, I can understand why prices are weak, but I don't think it'll last. And I think Transocean definitely has a part to play there. Could you comment on the position reduction in Dropbox? Was it simply to free up liquidity for home builders or TA on the chart? So look, Dropbox is a very simple business and I like it a lot. It's a boring business. It's a value play and they just continue to execute. It's not an aggressive sort of value play. It's not an aggressive growth play. It's just a company that I think is undervalued that I think will realize its value over time. I think that, as I went over earlier, I think as of right now, the market's really punishing, for argument's sake, companies like MI Homes. And when I look at MI Homes from a technical perspective, but also from a fundamental perspective and a valuation perspective, everything was lining up that I should increase this position. I think it's lower risk because of the fundamental backdrop and its valuation. And I still think I'll either materialize the same return or a higher return because it's deeply undervalued. Prior cycle, the market paid 8 times earnings. As of right now, it's trading at 2.4 times next year's earnings. We're expected to generate $16.63 in GAAP earnings on a $41 market cap, $41 share price. So it's trading at 2.4 times GAAP earnings. If earnings got cut in half and I was trading at 4.8 times, I still think I could double my money. And so that's it. That's just opportunity. Missed the outlook. Okay, H. We'll do them more often. There's not always a lot to say. Like, this stuff isn't going to change from day to day. That's just, the S&P 500 earnings. This stuff is not going to change from day to day. Where is it? This stuff is very slow. But if you understand the bigger picture, I think it becomes a lot easier then to really digest some of the decisions that we're making. And I'm not going to sacrifice the portfolio in the near term just because the price is down. Whoever was on the call last year in Q3, the expectation was higher volatility. I still believe we're going to see higher volatility. And then in Q4, Q2 this year, I was down 20% on the year. That's when I really had that realization that, wait a second, the higher inflation is more structural. It's staying here today. I'm not going to overtrade. I think I'm in the right positions in the near term, but I think overtrading, there's a lot of people killing it right now, absolutely killing it right now with high volatility, making some good decisions. There's a lot of leverage being used, very short-term trading. The more trades that you make, the more chance you're going to make a mistake. And then with leverage, it kind of amplifies those risks. I'm not good there, right? So I'm not even going to play that game. So I'm just going to focus on what I can control. But these things don't change very often. I do think we're going to see volatility, and I do think we'll realize strong returns medium to long term. I feel safe knowing my dollars. Oh, I really appreciate that, Mike. LG, hey Rob. First of all, thank you, very welcome. Second, we talked about cash is trash, but psychologically speaking, what is your take on holding cash when the sentiment will be negative and we see newer lows? Well, first of all, it's speculation that we see newer lows. I mean, in the near term, anything can happen. We certainly could, but we may not. And if you read the recent memo by Howard Marks said, look, as an investor, it's a higher risk for us not to be invested, to not be invested versus being invested, even in the global financial crisis. Why? Why do you say that? Well, let's have a look at this. Why did Howard Marks say that? So as investors, why would he say that? Here's the S&P 500 over the past 150 years. That's why he said it. So we had global financial, we had Great Depression, World Wars, somewhere in around, well, actually the World War performed very well. I think in and around here, we had a pretty deep recession in 1937. We had inflation. We had oil embargo and a crisis there as well with oil. We had the dot-com peak. We had the 1987 crash. We had COVID. We had a global financial crisis. We had so much stuff. We had wars, world wars with Vietnam, all this sort of stuff. What happened? Where are we right now? People can say, look, we're getting ready for a crash. But, you know, if I showed you this chart here, that looks pretty darn elevated and frothy, doesn't it? And then if you have a look, it was only a little bit of a pullback, and then it just went on a big, massive run. And so what Howard Marks is trying to say is, as investors, there's a higher risk of us not being invested versus being invested. The reason why I don't want to hold cash is because I know 1, 2 years out, 3 years out, 4 years out, my cash will be worth more. In the near term, it's an auction market, right? So the price is set in the minute, in the hour, in the day. And that price can be set based on emotion, based on expectations, whatever it may be. But longer term, it's set on earnings capability. Longer term, it's set on buybacks is about 7-8% of market cap growth. All of these things are, and multiple expansions about 10%, something like that. So you've got earnings at about 75% expectations. If earnings aren't going to decline, which I don't think they are, real GDP is forecasted at 3% this year. We've seen surprises in PMIs in the latest month. I wasn't expecting that. So it's a little bit better than what I first anticipated. So what I'm trying to say is, as Howard Marks says, for me anyway, and I'm not trying to convince anybody of anything, for me anyway, I see it as higher risk for me to hold cash because the money that I have in the market is not for tomorrow. It's not for next week. It's not for next quarter. It's not for next year. It's hopefully in 60, well, not 60 years, but when I turn 60, it's hopefully a pot to support myself. So I whatever happens in the near term, it doesn't really bother me regarding the market. It can go down, but the one thing that I learned about markets that, you know, my cousin's in the industry for 3-4 decades, and the one thing that he sort of brought to my attention that really changed my mentality towards investing is cash. It's nothing. It's just a piece of paper. It's a means to transfer one asset to another. So what's an asset? Well, I have loads of time, so I can go down to the bakery and I can make bread. So that's an asset to me. Now, when I bake that bread, I don't want to be paid in bread. So they pay me with cash, and I can use that then to buy food. I can pay shelter, whatever it may be, transportation, whatever it may be. So cash is used to transfer one asset, my time, for another, shelter, food, whatever it may be. So when you understand, like, cash is not, like, what is it? It's a piece of paper. An asset is something that produces above and beyond the input value, essentially. So I can go out and buy $100 worth of a stock that generates an earnings yield of 7% or 10%. Every year that company generates $10 in cash for me. I own it. It's part of the business. I own it. And depending on what the management do in terms of allocating that, it should generate shareholder value. Did I use that to buy back stock? Did they give me a dividend? Did I buy another business to grow out of opportunity? And that's ultimately the share price rising is essentially the economic benefit that I get. So what I'm trying to say is my view on cash is very different to everyone else's. I think cash is not just trash because inflation's high. I think it's the whole mentality behind what cash is wrong. It's not an asset. Leaving it in your bank, a classic example is during the 1940s, you left it in your bank, fine. What happened? You lost 70% over the pursuing decade in terms of purchasing power. So during inflation, cash is trash. But it's an asset to transfer value. And that's the way in which I look at it. So I would rather own MI Homes with a forecasted gap earnings next year of $16.63. Even if I'm wrong on that as their margin of safety, well, it'll have a 25% earnings yield if earnings dropped 30%. If it only generated $10, it has a 30% earnings yield. That's economic benefit for me. What the company does with that is different. So that's what my view is. I'd rather stay invested when the economic backdrop is still quite solid. And that's sort of the way I look at it. Holding cash, like, what are you going to do? If I sold out, like, if I look at this portfolio, I can tell you anything you want to know about these companies. Like, Tupperware dropped 33% yesterday. There's no way in hell I'm selling Tupperware after it dropped 33% on that article. It's even deeply under, I think its fair value is around $20 for this company. There's no way that I'm selling it. If I did sell it, I need to find another company that can generate outsized returns to offset that over a reasonable time horizon. It's very difficult. And if it all takes off without me, like, I don't know if the low is in place, but I'm just looking at our portfolio today. It seems to be doing okay. So I don't know if the lows are in. I'll show you what I think is happening from a technical perspective, but this is how I had it. We'll soon find out whether it's correct, but I had this up in 5 for a wave 1, ABC for a wave 2, into the 61.8, 1.382. So far, it's reacting very well. I don't know if the low is in place, but if I sold some positions, what do I do? As Mark says, there's a higher risk to not be invested. There's a higher risk not being invested versus being invested for as an investor. So that's sort of how I look at it. But I mean, it's a different philosophy. You really have to believe that that's the outcome. But time horizon is important as well, not just on stocks, but what's your expected return over what time horizon. If you need it next quarter, if you need the money next year, I don't think you should be investing in stocks. Too much volatility. If you don't need it for the next decade, there's a mountain of cash to be made. So that's sort of how I look at it. And I also think when sentiments are low, that's the best time to buy. As a contrarian, if valuations and macro lines up and everyone's thinking the same, someone's not thinking. And as of right now, everyone's expecting a new low and a crash. Maybe it doesn't play out. Who knows? Maybe it doesn't play out. And by the way, just going back to my view here, we have Bitcoin, and I know a lot of people think it's quite speculative and whatnot. We have Bitcoin in the portfolio, but let me explain why. Bitcoin's got fixed supply. There are loans backed against Bitcoin, so there is some sort of tangible value there, but it's the fixed supply that really is what's appealing to me. And when you look at this here, so when you debase your currency, something that's scarce like gold or whatever tends to do very well. Bitcoin is that scarcity. I know as of right, it is quite volatile. It's got a 85 vol versus like 15 for the S&P 500 for context. It's about 7 times more volatile than equities. So it is quite volatile. You can generate large amounts of return, but it can also diminish quite quickly too. So we've got two different plays. Leverage play on the industry with CleanSpark. It's trading at 0.47 times book value. Its tangible book value is $10 per share. It's deeply undervalued. It's producing at a profit, 15 million in liquidity, has time and patience in order for this to play out. I think it's going to push higher, but it'll be on the marginal price. It's like a commodity. So Bitcoin and CleanSpark is really a play on that as well. Everything else is more value-based, focused on the consumer, household, for the fundamentals that I mentioned before. I think it's just a little bit of patience. Could you explain something about your recent closures and cutting positions? Yeah, so I already spoke about Dropbox. Nokia, I cut it out of the portfolio. That is correct. Why did I cut it out of the portfolio? Well, I actually started to build a position in Builders for Source and MI Homes, and I used the cash to make those positions bigger. There's nothing wrong with Nokia, and in fact, this actually generates much better returns. We bought it in December 2020. It done better than the market, so 27, 28%. I think the market was up 17%, so it's done much better than the market. You may not realize that from the chart, but it did do better than the S&P 500. The reason why I sold it is because they've got 4.5 billion euros in net cash on a $22 billion market cap, and they decided to buy back $650 million worth of stock as opposed to maximizing shareholder value today. What do I mean by that? Well, Finland shares a border with Russia, and the share price got absolutely smacked earlier this year on the Russia-Ukraine war. That was a huge opportunity, an opportunistic opportunity to buy back a lot of stock at a disproportionately cheap share price. Management are too conservative, and I think one of the characteristics of a classic compounder is decent M&A, pretty good return on invested capital for, let's say, if it's incremental growth in terms of specific industries, return on invested capital quite strong, but also share buybacks at the right moment. Taking shares offline at cheap valuations is a classic characteristics of a compounder. And there are some compounders, great ones. So if you look at, let's say, the weekly chart, and you look at classic compounders, so one of them that we own is Pool Corporation. Since this is compounded at 20%, 21, 22% since inception, yes, it did go through a 77% decline, and it's still compounded 22% since 95, up until the present day. And we're currently down 35%. Really, really impressive. But this is a company that does a lot of strategic buybacks when the share price gets too cheap. Another company would be CPRT would be one, Copart. Another, these compounders have very obvious characteristics. Good, solid, durable business. They also have, pricing power. They also strategic and buybacks, M&A, all that type of stuff. And so like there's a lot of those type of businesses where the incremental growth in the equity comes from both earnings potential, and we've seen that with the company. Like Nokia done a fabulous job, really a fabulous job. Pekka Lundmark's up there with one of my favorite CEOs. They're very conservative. They done a fabulous job because previously they had an operating margin of about 9.5%. What they done was they unwound slow growth, low margin businesses that were capital intensive, took that capital, put it into other areas that were higher growth, higher margin. And they went from, in the first year, in 2021, Pekka Lundmark's full first year, they went from forecasted negative 5% in top line to growing 2.2%, but the margins grew to 12.5% on the operating margin. So way more profitable, decent growth, and that continued into this year. They're forecasting 13.5% operating margin plus growth. Management done a flawless job. They're too conservative. They've got 4.5 billion euros melting like an ice cube on the balance sheet. And more recently, even right now, you have a fantastic opportunity and they're just not budging. So although it's a great business, I just don't know if the equity will deliver strong returns. On the flip side, MI Homes is trading at a cheap valuation, very cheap, 2.47 times next year's GAAP earnings. And the management came out and said, we're buying back $150 million worth of stock. At the time, it's a $1.3 billion company. So they're buying back 12% of their float. That's going to give us tremendous tailwind long term. Taking 12% of the outstanding shares is going to massively spike the earnings per share and the free cash flow per share at a time when it's dirt cheap. You would need to go and buy another business that's trading at 2.47 times earnings just to get the same return. You can't do it. They got their net debt flat, I think. I think there's some capital leases, but the balance sheet's very clean. It's not like it's over levered. There's not much leverage there at all. And that's why I decided to do it. Longer term, I think I might get a better bang for my buck. I wanted to ask for a while. I feel like CleanSpark has much better operations compared to its competitors, but trading at a much lower multiple and less than price to book. Any thoughts why? Yeah, there's a fundamental reason for that. But let's just have a look at this. CleanSpark year to date. If we have a look at CleanSpark year to date, it's down 56%. If we compare that to Bitcoin, Bitcoin is down 58.86%. So CleanSpark is outperforming Bitcoin. Let's look at some other miners. I just want to explain why I think this is the case. Let's just take that off the chart so we can't see anything. So CleanSpark is outperforming Bitcoin, whereas their primary operations is actually generating Bitcoin. They do 12.4 on average per day right now. At a ridiculous margin. It costs them $6,500 all in. So let's have a look at some of their peers. Let's have a look at Marathon Patent Group. Let's have a look at Core Z. Let's have a look at HUD 8. Okay, so you have all of these different miners. CleanSpark is massively outperforming all of the other digital asset miners. So if you look at the next one, you have Marathon, and you have Riot in there as well. Riot's got a book value of 0.67. Am I right in saying that? I don't know, or it had anyway. But anyway, look at the massive outperformance first and foremost from CleanSpark. Huge amount of massive outperformance. Why? These guys are not taking any risk. All of the other companies have huge amounts of Bitcoin in their vault. And their plan is to hold on to that. As Bitcoin appreciates, they'll be able to realize a much better value. Fine, that's great. And I agree, as of right now, selling Bitcoin doesn't make a huge amount of sense. CleanSpark's strategy is very different. CleanSpark's strategy is liquidate enough Bitcoin to finance operations so that they don't need to dilute the equity holder and they don't need to issue debt. Right? So they've got $2 million or $3 million in cash right now. Let me check it now. I think they've got $3 million in cash and about $12 million in Bitcoin. They've got 550 Bitcoin. That's sitting in the vault. They got $3.5 million. So they got something like $15 million in cash, liquid cash. That's what they're using to finance operations. And so what is the question? Is it much safer? Why is it trading at 0.5 times book? I think it's part the market, but I think it's so cheap for the reason we mentioned a moment ago. A number of other businesses like Core Z have $1 billion in impairments. They also have $1 billion in debt. Marathon have a huge amount of debt as well. These companies are levered to the gills, and I think that's why the book value is a lot higher. CleanSpark has, I think it has a little bit of debt, but not much. Let me see. Long-term debt, yeah, $13 million, easily serviceable. So CleanSpark have $13 million in debt, $15 million in liquid cash as of right now. And what their plan is, as of right now, so at the beginning of this year, they were producing 10 Bitcoin per day. That's essentially where their mining capabilities were. In this crash, what did they do? They liquidated more Bitcoin, bought more discounted rigs, 40% cheaper than what the market was a year or two ago. Now, once they bring those miners online, they're producing 24% more Bitcoin per day. And the peak was 13.6 in one day. So that continues to grow month in, month out. So the amount of Bitcoin that they're able to mine is growing day in, day out. They're only financing operations. They're outperforming Bitcoin and all other digital asset miners, probably because it's so cheap. But I think it's so cheap because they're not destroying their balance sheet, essentially. So they'll do very well long term. I've no doubt about that. Core Z produces 39 Bitcoin per day. But the problem with Core Z is I wouldn't trust their management. $1 billion in what do you call it? Goodwill. So they overpaid $1 billion for assets, and they've got 1.2 billion in debt. They were forced to liquidate 70% of their Bitcoin right on the lows because they had no cash. They were up for bankruptcy. So a couple of mistakes from management. So you got to keep an eye on these sort of things. I don't think CleanSpark would put a foot wrong. I think it's going to perform incredibly well. Where are we? So that's that one. I don't think ICE invested 200 million into T0 because if they had invested that much, they would have to disclose that actual amount. Well, let's have a look. I don't know. I just heard that it was 200 million. I don't know. We'll see. They should have disclosed it. We'll see it now. So cash acquisition, 100 million. Is that it? I don't think so. Is it that it there? Cash acquisition, maybe 100 million. Sale purchase, maybe it's 100 million. I don't know. I don't know the exact amount. But there was rumors it was maybe they committed to 200 million over a number of years. I don't know. In terms of ICE investment in T0, which will make ICE a significant minority shareholder in T0, are not being disclosed in the financials impact. Yeah, no, I seen it on the message board. It's not out there, but cash acquisitions 96 million. Maybe that's part of it. It was paid in 2 stages, I think. Second stage was just paid not that long ago, so maybe it was 96 million. Overstock, where did Overstock had 10 million invested into it. So Overstock's where was that? This is Overstock, yeah. It'll be on the quarterly. We'll see. It'll stick out like a sore thumb. Oh, there it is. I don't know why. Freezing. Pay a bomb for your computer and it freezes. Oh, this is back to ICE. Sorry, guys. Free cash flow, quarterly report. Let's just see where they're disclosing it. I don't know whether it's this application or whether it's me, but this is incredibly annoying. There we go. Where was it? This isn't Overstock. It is Overstock. It should be Overstock. The numbers are different. I don't know what's going on here. This is not Overstock. Overstock didn't do operating cash flow of 969 million. Anyway, it doesn't matter. I think it might be that 96 million. I'm not sure, but yeah, they didn't disclose it, unfortunately. Did you average down on Overstock so much that you are now only down 8%? Or no, I didn't. I closed it and reopened it. My average cost is $44. I'm down a lot. Yeah, I'm down a lot. Not funny. Very frustrating. But so Overstock, let me just explain. This is another reason why I didn't want to be on YouTube. I'll explain exactly a scenario that I came across on YouTube. So I bought this in November 2020, and I put 1.6% of my capital into it right here. It screamed higher. I took 30% off the table, 75% up, and I left it. I didn't do anything. It was just sitting in the portfolio. Got up here, and then it started to drip lower. When it got to 53, I added a little bit more. When it got to 47, 48, I added a lot more. When it got to 39, I added a lot more. And then I think in and around 26, I think was the last time I added. Brought my average cost down to $44. I found out after the fact that a guy put 50% of his portfolio after watching my video. Now, I talk about diversification. I talk about risk management, know what you own, all that type of stuff. In one ear, out the other ear. 50% of his portfolio, average cost $88. I had 1.6% less than that because I cut it by 30% here. Overstock became a very appealing opportunity below $50. Not at 100, not at 80, not at 60. 50% of the portfolio in one position, I just think is bizarre. Couldn't do it. So my average cost is 44. I'm not down 15%, I'm down a lot more. But it's not something I'm too worried about. I'm down 40%. So I did average down, but I'm not down that much. Can you summarize your thoughts on Warner Bros. And Tupperware? So I've already went over Tupperware. Yesterday, I think it's a small market cap. I think this was a pump and dump. But anyway, let's just have a look at Tupperware really quickly. Tupperware's earnings were downgraded because they had challenges with inflation. They had challenges with labor. They had challenges with China, supply chain. At the time, they're trying to transition their business model. You get paid out massively on corporate turnarounds, massively if you get it right. So we built out a big position at about a market cap of, I'd like to say at the time it was about 300 million, but they bought back a lot of stock. We're in and around break even as of right now. So it was around this price. And they had reported after we bought GAAP earnings of $0. The next quarter, they made $1 million. And then as of right now, management are suggesting that turnaround is looking quite good. It was stalled anyway to begin with. Look at 2022. We weren't expecting 12% down. We certainly weren't expecting a 38% drop in EBITDA, but that's ultimately what happened. Over the next couple of years, the idea would be that this company sells off its non-core assets. It did. $85 million was raised. They used that to pay down debt in order to do a leverage buyback, which they've already done. They bought back $75 million worth of stock. There was like a perfect storm on the negative side in the near term, which caused the share price to drop 65%. Now, they had $250 million in the bank at the time, and the market cap is $250 million. I assessed the sort of opportunity. Yes, it's high risk, absolutely. But they had time, 12, 18 months at least. And I also seen that insiders were buying a crap ton of stock. All of these directors, these are all buys, direct buys with their own cash. This was not vested to them. This is their own cash. 33,000 shares for Hector Lesma, the CEO. Fernandez bought 35,000 shares. All of these are directors of the company buying around $6. And I said, you know what? I should join them. And we averaged down. We brought it from $14 down to $9. But we did rebalance at 20. We took 30% off with a 30% gain. So I was quite happy to build that position back out. It's not like the full-size position that we previously had was down massively. So I built a position out a little bit further down here close to the lows. Brought our average cost down to, I think, $9.12, something like that. And the plan is to just leave it alone and see this turnaround play out. And the reason why is because if it does turn around and we do get to a point where gap earnings are, $2 per share, these still have more buybacks to do, but it's trading at about 4 times gap earnings on 2023's numbers next year. I think that's a possibility. I really do. And the reason being is this is not a brand that just showed up in the last 5 years. Tupperware is around for the last I think it's since the 70s. It's a 50-year-old company. It's a very distinguishable brand. And what they're doing is they're going to let go of 500,000 door-to-door salespeople, and they're going to pivot online. It gives them much further reach, much bigger audience, and a much wider margin with digital marketing, etc., through their omni-channels. Some of it will still exist, but essentially the idea is to expand their margins. The reason why I liked it is it's a distinguishable brand, and the market wrote it off, and they still had cash. As of right now, they used some of their cash to buy back stock. They paid down some debt, and they still have $118 million in cash in the bank. They have $688 million in debt, so there is quite a bit of debt. But it looks like the worst is in the rearview mirror, and they haven't been losing more money quarter in, quarter out. So with Tupperware, it's a turnaround play, and if I'm right on it, I think the market will pay 12 times earnings. At 12 times earnings is a triple on the upside from where we currently are. And I think that those returns are fantastic. Even if it took 3-4 years, 300-400% is pretty darn good return. Unfortunately, though, Bed Bath & Beyond has gone through a restructuring. They are partners with Tupperware. Bed Bath & Beyond is not necessarily going to shut down all its stores. They're going to obviously remove its footprint from less performing stores. But because of that's ongoing, when something like this comes out, I think the market kind of panics. Now, this is a total crock of shit. It's just total nonsense. It should be investigated, in my view. I don't know how you can say a couple of hours before they released a new senior vice president for investor relations and say that, they're going to keep investors in the dark and investors relations are not going to speak over the next couple of months. And then they come out and say, all is well, literally a couple of hours later. Share price dropped 33%. It's no surprise to see it up 19% today. I think that was I think it was an opportunity. If I had more cash, I probably would have averaged in, but it's pretty disheartening to see. So yesterday's performance is not a fair reflection of what's going on in the company. That's why I didn't sell it. And I think longer term, if the turnaround is successful and it looks like the worst is in the rearview mirror, still a lot of work to do, but it looks like the worst is in the rearview mirror. I think the longer term, this does tremendously well. So as of right now, look, it is what it is. It's just unfortunate yesterday to see that. I wasn't expecting that, but we also got interestingly, we got our DeMark perfect buy here on the daily chart. So we had an exhaustion in terms of a couple of technical patterns. You got your perfect buy there and a bit of a reversal. But anyway, look, let's look at a draw in the near term. Long term, for successful, we'll make a lot of money here. It's a smaller position, but it can give us a little bit of torque. Warner Bros. Discovery it's just been a disaster. It really has. There's nothing else really to say about it. I learned a lot with this, though. The way in which I look at a company is I evaluate the current market environment. So we'd have a look at market environment, the opportunity in terms of its assets, its potential growth, its balance sheet, if there's any risk there, and the potential to grow at its value into the future. look at the sentiment and all that sort of stuff, and I come to an agreement, some sort of idea that this might be a good buying opportunity. So it was at the time where Discovery was going to merge with Time Warner. I learned a big lesson here, and I'll explain the lesson I learned in a moment. But they were going to merge via reverse Morris trust. 71% of the shares would go to AT&T shareholders as a dividend, and the reason why that was that structure is because it's tax efficient. The way I looked at the company was I didn't look at any of that. It's the first time I went through a reverse Morris trust, but I looked at the company and I said they had 74 million subscribers to HBO Max. It was the second best content producer in the world, maybe even the best, with some of the best franchises, including, for argument's sake, Game of Thrones as an example, like some really, really high quality content. And they only had 74 million subscribers. What Discovery offered to them was a network across Europe and international markets. They had partnerships to push it down different channels with Vodafone. So here in Spain, every single advertising is cross-promotion, Vodafone and HBO Plus. So I seen that as an opportunity to scale up the subscriber count. And at a 50% free cash flow margin, I thought there was a tremendous opportunity to massively scale up the free cash flow. It's a massive leverage buyout, $43 billion on the balance sheet. It's a lot in debt, but it was producing about $7 billion in cash flow with the marginal growth coming from international markets. So far, what's happened? 74 million subscribers, we're currently at 91, guiding towards 130, which might be conservative. Those subscribers to HBO Max have a 60% free cash flow margin. There's 200,000 hours of content. It's a really deep library, really, really, really deep library. And so far, it's very successful. The challenge has been when they took over the company, they found an awful lot of boogeymen in the closet. For argument's sake, CNN Plus, they spent $150 million to get 100,000 subscribers, or maybe it was 300 million. I can't remember the number, but it was hundreds of millions of dollars on CNN Plus. And they maxed out at 100,000 subscribers. It was somewhere between $1,500 and $3,000 per customer just to acquire. And so it was a total vanity project that had no scale, that they completely overspent money on, which is typical of AT&T. Go and look at AT&T's track record of M&A. It's a total joke. It's laughable. The destruction in terms of capital from AT&T is unreal, and it obviously continued with Time Warner. So they had to shut that down and restructure. They shut down the project and they rolled CNN Plus into a different part of the business. There was loads of little projects like that were just burning cash. They still have a content budget of $6.3 billion, but they've been able to save a lot of money with these vanity projects. A couple of concerns I might have operationally, going back and licensing content with Amazon. I don't know if that's a good deal or not. As of right now, apparently it's a different deal versus the prior deal that they had. So maybe there's more upside to it. I don't know. But fundamentally speaking, the company's doing quite well in terms of sub growth. There's been a couple of challenges in restructuring, and there's been a lot of changes. And I look at Zaslav's compensation because these are a lot of changes that were made that I can't quantify that could be beneficial. I don't know. There's just been so many of them in such a short period of time. So look at Zaslav's compensation. He's a billionaire if he turns this around the next 3 years. But he needs to get the share price to $43 a share. So those changes, I'm thinking in good faith that he made the right decision. I'm trusting him as the CEO that he's made the right decision to delever the business, which he already done with Scripps. Discovery bought Scripps for $12 billion and it was 5 times leveraged. The net debt was 5 times EBITDA. It was massive. That's essentially where we are with Warner Bros. Discovery as of right now. So he already delevered inside 14 months, Scripps, with Discovery. I think he can do it as well with Warner Bros. Discovery. So he's already has experience deleveraging, and there's still a huge opportunity. They have been executing. So I think that it needs a little bit more time. Why did the share price sell off massively? Going back to the reverse Morris trust, I've never been in one of these deals before, ever. And ultimately what happens is it can only work if the parent company that's spinning off a piece of their business gets the majority of the shares. They need 51%. In this case, they were getting 71%. In a falling share price environment where sentiment's terrible, we started to see a liquidation of these shares. How do I know that? The average daily volume doubled. After that acquisition, the average daily volume doubled. And so I knew that there was a massive amount of liquidations going on. That caused forced selling, gets the share price down to bizarre levels. And that's the big lesson that I've learned moving forward when I'm looking at reverse Morris trusts. Probably better to get involved. Maybe if there's a falling share price environment, probably better to wait. my view on the company is it's still very cheap. My view on the company is there's still a huge opportunity here. And, it goes back to that view. It's in a diversified portfolio. And the question is, what do I do? If I sell it, is there another company that will give me the same opportunity? Still think this is worth $50 to $70. So it's at $12.70. If I sell it today, it's that expected return that I miss out on. So I need to replace that expected return. I'm not willing to do that right now. So I still think that this is an incredible opportunity, but there's a lot of lessons that was learned here. It's not that I made a lot of mistakes, but I learned a lot of lessons. I didn't know the mistakes to begin with. So fool me once, shame on me. Fool me twice. Fool me once, shame on you. Fool me twice, shame on me. So I'll be looking out for that in the future. So that's sort of my view on Tupperware and Warner Bros. Tupperware I'm not concerned about. It's a smaller position. Warner Bros, I allocated a lot of money to it. So it's definitely hurting for sure. Am I still planning in the future to stay with the strategy to look for turnaround business with 12, 24 month time horizons, or looking for good quality businesses with longer time horizons? A bit of both, to be honest. I've always kind of looked for good quality businesses, and I've always looked for turnaround plays. Some money that I made, like good quality returns I made, was on companies that were close to bankruptcy and actually went bankrupt in the following years. Whiting Peat, WLL back in 2016, Chesapeake around that time as well. Both of those went to Chapter 11. But again, going back to the commodity argument, it's about the underlying commodity, and natural gas prices for Chesapeake were starting to improve, which meant that the marginal cash flow would improve, which meant Chesapeake was a heavily geared sort of shitco essentially. And that doubled in share price. Not Warner Bros, but Whiting Petroleum was another one that was another opportunity. I heard Tupperware is down because of investors cut huge positions. Share price is set by the marginal buyer and seller, so there was a lot of people that sold yesterday. That's not a rumor. Somebody sold a lot of shares yesterday, for sure. Gold has been holding up pretty decent, but equities have been crushed. Seems to be a disconnect and perhaps an opportunity. Well, gold is down on the year. I think gold is getting closer to a low, but it's just 6%. I actually think gold is probably already bottomed. There's one company that I like in the gold space, which is Equinox. High all-in sustained cost with good geographical locations in Canada and the United States, about 50% production, and the other 50% is Mexico and Brazil. High all-in sustained cost, $1,400 per ounce. But with falling diesel prices, falling gasoline prices, going to give them a tailwind. With higher gold prices, could be very interesting. It's not listed on eToro, but I don't know if I'm going to get involved with gold miners, but there's definitely an opportunity there for sure. Thanks for the stream, Rob. You're very welcome. Do consider doing them in the future. You're very good at what you do. I really appreciate that. Often wrong, but never in doubt. Never forget that. Last question for me. Are you still following Volkswagen? I'm not. I got a little bit discouraged by Volkswagen. I'll tell you why I got discouraged by Volkswagen. Herbert Diess left, right? He left. I thought he was stepping down or moving role. Anyway, I think Herbert Diess is a weak CEO, put it lightly. He gave loads of control to the unions. He bottled it on a number of different deals with China. They're spending, I can't remember, was it 16 billion euros on software and whatnot? Yet they were very reliant on China software. There was a lot of stuff that didn't, like, I was looking at it, I'm like, it's too bureaucratic. Very cheap company, but sometimes companies are cheap for a reason, and I think in that case, that's probably what happened. Seem to have sold out, yeah. So yeah, energy costs are up pretty significantly in Germany. So manufacturing for the auto sector in Germany, a lot of that's been outsourced to Morocco. So yeah, Germany's GDP will roll over. Volkswagen will probably be okay because they can outsource it to different regions. But yeah, it's a challenge for anything that's manufactured. Germany, Volkswagen will be fine longer term, but Germany in the near term has a lot of problems. Energy is still reasonable here in Spain. It's very reasonable. Prices have increased. I think I pay 100 a month. No, I don't. I don't know how much I pay. I think it's 12 cents per kilowatt. It's up about 100%, something like that. It's not crazy. Spain's fine, Portugal's fine, but Europe is very interesting because, for argument's sake, Spain has 2 pipelines into Algeria for natural gas. They also have 12% coming from wind. And wind, all their wind farms, most of them are in Cadiz, which is notorious for being very windy. They have it out in the sea. So that continuously produces energy. One of the rare spots. You got to be very careful where you put those windmills. So 12% of the grid comes from wind. A lot of them are in Cadiz, which is a lot of crosswinds. Natural gas coming under the sea from pipelines out of Algeria. And there was an agreement made between Portugal, Spain, and Europe, where what happens in Europe is the price is set based on the highest supply of whatever mineral it is, whether it's coal, whether it's natural gas, whatever's the most expensive. That's what the average price is. Spain, we broke away from that. And because we have diversified energy here, yes, prices went up, but not close to what happened across Europe. So if you look at, I don't know, it's about 1/3 the price of France, for argument's sake, a little bit less. France, yeah, it's a lot cheaper. So Europe's kind of interesting in that sense. We'll see. Things can change pretty quickly. I've had overstock since last year. Haven't added, but not going to sell either. I care to touch. Yeah, we already spoke about Warner Bros. Just literally a minute ago. You might be up to wind. Joined in late, unfortunately. Did you touch on macro conditions? Yeah, concerning Europe energy crisis and China economy supposedly collapsing. I've been hoping for a live stream for ages. Okay, so we did touch on the macro, but it's more US specific. If we pop on over here and we have a look at bullshit.me, a dashboard, pretty much all of our equities are in the United States, 85%, but that's because the open P&L is down 10%. Pretty much all of it's in the United States. Germany, it's BioNTech. It's not in Germany. BioNTech have 21 billion euros sitting on the balance sheet. So a lot of cash there. United Kingdom is Royal Mail. And then the Swiss company it's not a Swiss company. It's just registered there. It's Transocean. Most of the companies that we invested in, it was very specific. Like, let's have a look at, for argument's sake, even when you're looking at, we own a company called Nucor. I was very careful about the type of businesses that I wanted in the portfolio. If you look at the revenue, geographic revenue, it's not coming up. Anyway, it's pretty much all the United States. So I was very careful about choosing demand end markets that were very much dependent on the US. Lennox International, mostly US. Taro Company, mostly US. All of these companies. Pool Corporation has 90% revenue in the US. So that was one of the, look, I don't know what's going to happen in Europe. I can tell you one thing, the world's not ending in Spain. The world's ending on Twitter for Europe. But demand hasn't slowed down. Every place I go, it's hard to get a table on the weekend for a restaurant. I live in a bubble though, so I'm not the right person to really comment on it. So yeah, I really don't know, but I don't see the world ending, certainly in Spain. I do see it online. So it's kind of interesting. I don't know what happens in Europe because it is very much dependent on energy and energy supply. So I don't know. But one way in which I was able to protect capital is really focus on companies that are US specific. Home builders. MI Homes only build homes in the United States in a couple of different states. Florida, Texas, etc. Starter homes, which are better priced. Builders First Source only supplies to the United States. Overstock is an e-commerce business only for the US. So I'm really just focusing my attention on the US and revenue coming from the US. And of course, the consumer in the US, which we went over as well. So macro was at the beginning. It was probably an hour of talking and rambling, but you might be able to check it out. I was looking forward to seeing a discussion with Fabio from Capital Mindset, which you seemed interested in. Is that still on the table? Honestly, I just want to get away from YouTube, as I mentioned at the very beginning. I think, at least in the near term, I think there's still a lot of froth. I think the worst thing that ever happened to the retail movement was Wall Street bets. And I didn't realize it until this year. And I'll tell you why, because the market was up in 2020, the market's up in 2021. I think it was fun for everyone to sling shit at me because I say diversification, valuation matters. I'm down this year, but I know there's a lot of people reaching out to me that are wiped out 100%. Optimizing leverage, concentration, no idea what they own, have no idea how to get out. And that negative sentiment, it needs to flow through. I'm delighted to see a lot of people consider indexes, but with the right mentality, you got to add to it every month. I add to my portfolio every month, when and where I can. It's not about buying. It's not about buying the absolute low. It's about building wealth over time. And I think we just need a couple of quarters for that to flow out. And then we get back, like I was talking about, like I'd done a couple of videos. There used to be a cool sort of stock market scene on YouTube years ago. No one really existed. Every channel was like 100 people here, 100 people there. And it was real good, engaged sort of conversation. Nobody wanted to be the next big thing or anything like that. It was just about investing. It was great. Kind of lost that after 2020. This idea of YOLOing, and I just think it's disappointing. So I don't really want to, like, I haven't watched a YouTube video in the finance space, I would say in 3 months. I don't even know where YouTube is right now, but I would say it's in meltdown, housing market crash, stock market crash, bury this, bury that, Cathy Wood this, Cathy Wood that, whatever. Probably predictable. Did I sell Nano Dimension because of Yoga? Yeah, I did. I honestly, if I was a wealthy investor, I would probably sue this guy, because let me give you a backdrop of what I liked in Nano Dimensions. I love roll-ups, and that's why I kind of like this company, One Water Marine. I did request it. I would swap out one of the companies in the portfolio, maybe something like Royal Mail. But I love roll-ups where there's value add with a tech stack. It's early enough where they haven't rolled up enough of the industry, and you can re-rate these cheap private market companies in public markets. Love these type of businesses. I've always wanted to do one myself. I thought about doing it here in Spain with bakeries and stuff like that, but I never pulled the trigger. There's about 12,000 bakeries in Spain, so you could roll up a lot of them and vertically integrate them. But Constellation Software is the one that has really brought it to my attention. This is micro roll-ups of small businesses, and I love the idea. When I looked at Nano Dimensions, the CEO said, I can pull it up, probably not now because it'd take me a little bit of time and we're already over 2 hours, but the CEO said that they're going to do micro acquisitions to strengthen their supply chain, use their IP, push their products in those supply chains to ramp up their revenue. You get cheap private market deals that re-rate and are profitable, and at the same time, your marginal growth comes from your product sales. Sounds amazing, doesn't it? Sounds absolutely amazing. I buy a company, I think it was like $3 billion, with $1.3 billion in cash, with a very crystal clear move forward. And this idiot comes out a couple of months on the latest quarter, or maybe the quarter before that, and this clown comes out and says, no, we're not going to do any buybacks. He completely ruled that out, and I'll tell you why that's stupid in a minute. And then he said, we're not doing any M&A. We're just going to increase maybe several dozen in R&D. And I'm like, you guys are absolutely unbelievable. And the reason why I say that is because let's have a look at Nano Dimensions' enterprise value. So you got a situation where the market believes that this company is worth, its enterprise value, negative $584 million. Essentially, the market believes that their cash, they're going to literally wipe out $584 million. Literally going to go to zero. Find me another company that's outside of China, of course, that has a negative enterprise value. And find me another opportunity where you can buy back your stock for less than your cash position. They don't exist. They had $1.3 billion on the balance sheet. They could buy back $600 million worth of stock at negative cash position. That would generate shareholders' return long term. They're talking about spending several dozen million a year. So they've got 1.3 billion. Let's just say they're going to spend 5 dozen million. I don't know why you used the word dozen anyway. Maybe just trying to be smarter than he is, but let's say he spent 5 dozen million, 60 million a year on R&D. It's going to take 20 years to hack through that cash. Why not use it right now, buy back your shares, because hopefully in the next 5 years, you're going to be profitable, right? It just didn't make any sense to me. And it was really frustrating because the entire thesis that they sold a year and a half, 2 years ago, when I bought it, completely turned on its head. So opportunistically, I looked at nano dimensions using the mark. We had a 13 exhaustion right here on the highs, and it would look like a diagonal pattern. So we got out at about 350. It's now trading at. Can you believe that this company has $5 in cash per share, net cash, and it's trading at 268? That's buying a dollar for 50 cents, but it's actual dollars. It's not assets that need to be liquidated. It's actual dollars, and that's a challenge. Not related to anything here, but I seem to remember that you were working on an anti-smoking company. Are you still working on that? Very curious about it. I'm not. I'll tell you why I'm not working on it. I'll give you a bit of the journey, Patrick. Don't even know what year I started that, but I started it maybe in 2017, or maybe it was 2018. And clear plan, we were going to build a hardware. And that hardware was going to be an electronic cigarette that had a chip in it, so we could program it. We could turn it off, turn it on. It would be connected to a mobile application. And on that mobile application, it would be about, there was a lot of behavioral science that was built into this behavioral application to help people quit, gamified. And we worked with a guy called, what was his name? Head of Glow, what was his name? Guy, what was his name? Can't remember his name. Harvard. Anyway, this guy, Dr. Von Rees. I couldn't remember his name. Dr. Von Rees. This guy was a lecturer on behavioral science in Harvard, and he was also head of global tobacco control. So I reached out to him and said, "Look, this is what we're going to do. Would you mind helping us?" And we came up with a program. And I had loads of different ideas. And then we came up with this platform. By the time we agreed the schematic of the platform and how we were going to build it, there was a problem with dueling in the United States. Was it 2018? Yeah. 2019, around this time here. It was 5.8 million kids that were addicted to vaping. And they brought in regulation and they banned it. And we had a company in China manufacture our device, our prototype. We're building the platform on top of that. Regulation came in. So then we had to change our plan. And we went to a company called CTAI. These guys were actually pretty darn incredible. These guys built us, do you know, like the ICOS that Philip Morris has? They built us the electronic schematic inside, I don't know, like 12 weeks. It was incentivized. We made an incentivized program for them where we'd pay them a lot of money if they'd done it on time, because we needed to raise some money before more regulation came out. But anyway, we got to a point where then they started considering regulation on electronic devices. So then we had to pivot again. So anyway, I'm burning loads of money along the way. And then we reach out to a company in Finland. I can't remember the company's name. Anyway, we reached out to this development company that actually came up with the schematic and the design and the prototypes for the Aura Ring. And we were going to get an algorithm that predicted the hand movements. So every time you went to have a cigarette, just based on your finger movement, you'd be able to predict whether somebody was going to have a cigarette. And we'd be able to monitor it and use the platform that way. And then I got the bill to develop it, and it was 1.6 million euros. So that was not for commercialization or anything like that. That was just essentially to build up prototypes and get the molds. And I was like, at the time, I could probably invest in it, but there was no guarantee, and I wasn't taking that risk because I already had 2 kids, so I wasn't taking that risk. I would be bankrupted. So I started on YouTube, and I thought if I built an audience, 1 in 7 people smoke. So I knew about investing. Again, it was just a combination of needed to do something, knew about investing, and I could leverage this as well. And if I had an audience and I went to an investor, there might be a higher probability that they might invest in the company because there was no way I could put that money down myself. Anyway, got a guy that would, or a fund that would invest, but they wanted 50% equity because of the risks. And then I realized that it wasn't going to be reasonable. I had already given away way too much equity. I had a lot of partners, and it was a situation where everything worked, but one or two things didn't. Regulation changed at the wrong time, and I ended up burning $250,000 on it. And so, at least for right now, I've kind of sandbagged it. Not rich enough to push for those sort of things. Not right now. I'd like to do it at some point in the future, but I've got a number of years to catch up. Thoughts on Zim? You had it in the portfolio, getting crushed at the moment. Yeah, I did have it in the portfolio. I removed it because tensions were increasing between US and China over Taiwan. A lot of shipping routes go from the United States to China. And so if they get impacted, forward guidance would be downgraded. That was a bit of a risk. And then technically, I was looking at the chart structure, which was up in 3 waves. And I was looking at the mark. And I got a second opportunity. I was very lucky. There was a second sell. So you had a perfect sell, and then it sold off very heavy. And I decided to get out of it. There was too much geopolitical risk. Technicals were not looking good. I got out of it. I think we made 5% or something like that. I like Zim. I really do. And the reason why I like Zim is because they've got $27 in cash. And it's trading at $31.48. They're committing to pay out 30% of their net income in Q3, 50% in Q4. So that's a lot of cash they're paying out in dividends. Analysts in the shipping space suggest that rates are not going to bottom until mid to late 2024. So it's massively under earning. And if you take out capital leases, the company has net cash of about $500 million. So it's not an expensive business, deep value play, but leverage to China. I guess you got to take a cue. The first time it pops up, okay, it looks corrective. I'll take note. Second time, perfect sell. Okay, I'll take note. Third time, perfect sell. I got to get out of here. And anyway, as of right now, somewhere down around $27 could be interesting. And if I'm looking for, if I need to rotate some capital somewhere, if for whatever reason, Zim could be very interesting, about $27, which is equal to its net cash position. We've got $3 billion in cash. Is it 3? Yeah, 3 billion, 3.3. Market cap is 3.7. A lot of cash, lots of cash, for sure. Tension, I don't know why it's selling off. I didn't have the time to look into it, but I will look into it pretty soon. I think that we're not done on the downside yet, but I do think commodities are going to get crushed in the near term. I helped write an article for the Irish Times, and then I went into the Times in the UK on how to invest in a recession, and they completely twisted my words, which is disappointing. But in it, they said owning oil and gas and commodities is a good idea. And I was like, it's not really what I said. I think at the right price, they're very interesting, but I think all of these have pretty decent drops. And so if you look at, for argument's sake, ExxonMobil, so ExxonMobil, just to show you, most of the revenue comes from refined products. So if you have a look at the segments, you'll see that downstream is. So you got downstream here, 101 billion in the United States and 165 ex-United States. That's $266 billion on net income of, 266 billion out of 352 is refined products. If you look at gasoline as an example, gasoline is just being fallen out of the bed. And if you look at this long term, gasoline obviously is correlated very close to Exxon. Oh, what did I do? Pinton, who's got right. So gasoline is being correlating pretty close to ExxonMobil because ultimately most of the revenue comes from refined products. Crack spreads are collapsing. Look at the gap there between ExxonMobil and where refined products are. So I think it's going to be a catch down. And I'm seeing that across the board where there's a massive disconnect between realized cash flow of these industries and where the share price is trading. And I do think that there will be opportunities in the future, but it's unreasonable to pay where we are at the moment. That's sort of how I look at it. But at some point in the future, Adobe is one where I could cut. Royal Mail is one where I could cut at the right prices for energy. I think the risk reward, and Mosaic, I think the risk reward would be a a lot better, but we need lower prices. So that was, since you are very heavily invested in the United States, could you speak about regional diversification, its merits or lack thereof? Do you mean like geographically, as in United States and the rest of the world? I don't believe in that whatsoever. All the capital flows to the strongest economies, and the strongest economy is always the United States. And the reason being is because it's the world reserve currency holder, and there is no one to compete with the world reserve currency holder. So strong dollars, it's not going to impact your macro. Weak dollars, it's not going to impact your macro. Now, if you're Brazil and you've got tons of US dollar debt, and the dollar gets more expensive relative to your local currency and interest rates rise, your country's going to get crushed. If you're an Asian emerging market country right now, which is under a lot of pressure, you're going to get smacked. You don't have that impact over in the United States. And so I always prefer to invest in the US. Capital always flows to the strongest economy when growth slows as well. And, I'll give you one reason why that's the case. Like, you look at euro dollar, like my local currency is euros. Maybe some of yours is, I don't know, British pounds. But if you look at this year to date, my real return in local currency is not negative 20, whatever it is. It's 12% less than that, because if I just left it in euros relative to the dollar, I'm a lot weaker. So my realized euros is a lot higher. Capital flows to the strongest economies and the strongest currencies. So my view is that US is always a safe play, always. Now, if the world reserve currency changed, then I would change my mind. But that doesn't look like it's going to happen in the next decade anyway. So we'll see. Energy prices coming down. If they persist, euro is going to push higher. So keep an eye on that. I don't know for how long. I'm just messing around with a chart to try and figure out what's going on. I was thinking that maybe this is like, I don't know. I have no idea what's going on in Europe, to be honest. Even though I live here, I mean, it's really hard to know. I don't have the answers to everything. But 1, 2, 3, 4, 5 would be a leading diagonal A, B, C on the downside. Yeah, I don't know. That would get us down towards about 80 cents. Worst case scenario, US recovers. Best case scenario, US recovers and the euro's down another 20%. My wealth just grows 20% in local currency plus the marginal growth in a recovery. We'll see. Any thoughts on Meta? I love Meta, and I think Zuckerberg is a stud. I think he is a phenomenal CEO. The fact that he went on to Joe Rogan, knowing that Joe Rogan's going to ask difficult questions, says a lot about Zuckerberg. Find me another guy that's worth tens of billions of dollars and he's hustling like Zuckerberg is. I wouldn't bet against someone like that. I really wouldn't. That aside, like whatever my view of Zuckerberg, I think he's very misunderstood. I think he's very socially awkward. I think he's an easy punching bag. And I think that's ultimately where we are. The fact of the matter is, a lot of the sort of censoring on Facebook is from a third party. They hire 35,000 external people from the company to actually decide on a lot of decisions. Nobody else is doing that. Facebook or Twitter, this is horrendous to actually know about and still, and still use the platform. But Twitter is over 50% of their staff have access to my personal information. I just think that's horrendous. So I think that Facebook, get a lot of hate. That aside, what have they been doing? Investing in infrastructure in India and across the coast of Africa. That's the marginal growth long term, where the earnings potential of Africans is only going to get better. What's probably going to happen is India becomes the new China, because China's got a large aging population, same with Vietnam. Vietnam's probably going to take a lot of business. We're already seeing that. iMac, iWatch, it's all being now manufactured in Vietnam. I think India is going to be a similar play like that. A lot of the farming that's in India, I think, is going to go over to Africa. And so anyway, wealth is going to be built up over time. Nobody's invested in infrastructure there. Reduces the risk as well, because they only access to the internet. And when you're looking at controlled labs and you're looking at the combination of controlled labs, which they bought in 2019, and Oculus back in 2013, it's a perfect structure for the metaverse. What is the metaverse? It's just the internet 2.0 in 3D. I put a pair of glasses on. I want to go to the supermarket. It's a more visual or better representation of online e-commerce. And I think the reason why Facebook are investing so aggressively today is because they want to own the infrastructure. So what infrastructure do I mean? Well, who is the gatekeeper of the internet? Google is. No matter what I want on Google, I got to go to Google search. They've got like 70 or 80% of the market, maybe even 90%. So they're the gatekeeper of the internet. Video is used an awful lot for search as well. They're the gatekeeper of the internet with YouTube. I think what Facebook are trying to do is build the infrastructure to be the gatekeeper in the metaverse. And it's not that I think that, but that's how Mark Zuckerberg has communicated it. And so they're spending a lot of money. And even if that's a zero, the company's still profitable. It's still a value play. But even if that plays out, as Zuckerberg said on the last conference call, the opportunity is hundreds of billions, if not trillions of dollars in revenue. And I believe that to be fairly accurate. I think it opens up massive, massive, massive opportunity. That aside, look at WhatsApp. They just opened, Polymart over in India. You can actually buy fresh food and on your WhatsApp. So you're starting to see a marketplace open up. Meta Pay is going to be leveraged there. There's 340 million users for WhatsApp Business. So it's very diversified. I think it's hilarious. I've seen some clown the other day talk about how Facebook is the next MySpace. MySpace was an interface. That's it. It had no infrastructure. And they scaled too quickly. And that's why they went to zero, because their costs overran their revenue. And the revenue was coming from places like the Philippines. So it went to zero. Facebook took it slow, concentrated on high revenue markets, the United States. ARPU in the United States is $60. Huge. It's huge. So look, I really like Facebook. I like it for the long term. I liken it to Apple back in 2016. I don't know if you guys were looking at Apple in 2016, but Apple was a boring hardware company that was going to zero. It was destined to complete the fate of BlackBerry and Nokia, its two predecessors. That's what the sentiment was. Trading at like 10 times earnings. They didn't have much software revenue. Margins were quite low, but everyone thought the business was dead. Today, we look at Apple and say, wow, look at a great business. It wasn't like that 6 years ago, I promise you. It was the next BlackBerry. That's what the consensus was. Didn't play out that way. And so I think Facebook might be a similar play because of all the investments. They just raised $10 billion for a leveraged buyback. They can do M&A under the, competition law. I can't think of the name right now. Getting a little bit tired. But anyway, there's a cap on anything over $600 billion gets scrutinized by the FTC. Meta's market cap's only 450 billion. So they can do or 430 billion. They can do some M&A for sure. So I do think there's a little bit more weakness, but I love this. I think long-term it's going to do very well. Very comfortable. And the fact that Zuckerberg is out there hustling like it's day one makes me a lot more comfortable as well. And I know that's it's a very unpopular opinion that Zuckerberg is a good CEO, but I can only base it based on the merits of what I've seen, but I like Zuckerberg. The regulation makes no sense. Vaping is a great tool to quit cigarettes and slowly reduce nicotine. Yeah, I agree with that to an extent. But one thing we realized is we looked at a lot of studies on e-cigarettes. The problem is liquid actually develops in the lungs. You end up with a lot of glycerine in the bottom of your lungs, causes inflammation around the heart. We haven't been vaping for long enough, so we don't really know the full consequences. But yeah, it's maybe a lesser of two evils. The problem with cigarettes is not the nicotine. There's loads of nicotine in tomatoes. It's got high nicotine concentrate. So the problem with smoking is carbon. That's the carcinogenic part. Do you have any ownership besides Cameco outside of eToro? I have some digital assets, but I'll show you what I own in digital assets. I bought Bitcoin back in 2018 and I held that all up until recently and I cut it in half right on the lows. And you might say, well, that was a dumb decision, but I'm putting it all into CleanSpark and Hut 8 mining. And the reason being is every once in a while an opportunity will present itself where the risk versus reward is right for a 20 to 40x return. And I think right now that's the case for CleanSpark. So I'm building out big positions in CleanSpark and Hut 8 mining as of right now, but I'm not adding any money to it. I'm just cutting back pretty decent sized position in Bitcoin and just adding a little bit more leverage. I'm either right and I'm going to knock it out of the park and I'm going to buy an island and disappear. I'm not really, but or I'm a little bit wrong. So I own Bitcoin, CleanSpark, HUD 8. It's still very slow to build out HUD 8. CleanSpark have built a lot more because you have that, as we mentioned earlier, that valuation. I own some Binance. I took a small position in Binance. We used to own it in the portfolio actually, but why did I close it? Something happened to the portfolio and I closed it. And on that day, it was up 10%. It was somewhere in and around here. And I was like, okay, I'll wait for it to pull back a little bit. And it never pulled back. Michael Saylor started investing. I thought it was the institutional phase for, what do you call it? Can't think right now. Digital assets. And I look back and I think that's ultimately how it played out. But I added at midway through 2020. Yeah, it was about a little bit less than $20. Got very lucky, played out very well. I cut 30% of the position at $307, and I'm sitting on the rest. I think this can go up to 1,500. I've already made money. If it went to zero, it wouldn't bother me, but I'm being a pig here because I think it can grow. That's the only reason why I own it. I wouldn't build it out any further. That's why I wouldn't add it to the portfolio right now, but I've already reduced risk there. I have a small position in Basic Attention Token. Don't know if you guys have ever heard of this. This is the worst performer that I have. Basic Attention Token actually solves the problem. The Brave New browser it's kind of like Google. It's a browser that's scaling in terms of users. But if you're on YouTube and you get AdSense, you create content for 30 days, and then 21 days after that, in the next month, you get paid for that in terms of AdSense. If it's less than $100, they don't pay you out. So what Basic Attention Token solves is if I watched an ad as a user of the platform, I get paid. If I create content on the platform, I get paid. And then the Brave New browser, the company, gets paid. How do you distribute that in real time when it's like a fraction of a cent? They have to create a digital asset to distribute cash. So it's a play on the adoption rate and speculation of the Brave New browser. Honestly, I thought this was going to be the safest one. I paid 20 cents. It's at 32 cents. Not terrible, but I thought it would have been better. And I used to have a position in KuCoin, which I thought was a zero. I bought it at 80 cents, and then it got hacked for $240 million. And it continued to drop while everything else. I thought it was a zero, but they actually managed to get that $240 million back. It's kind of interesting. They chased the guy around the internet, and they got that $240 million back. And then the share price exploded, but it was more speculative, very small position. It done very well. And I got these are exchanges, by the way. So they're utility tokens connected with exchanges. It's kind of like buying Coinbase, except very different. It's just a utility token that people be using. Outside of that, that's all I have. But I'm pretty much de-risked in this space. I've taken some profits along the way. So I have Cameco. I have a couple of other uranium miners that I bought, really small positions. I was down 70% on this. I bought it in 2019, 33 cents. I think it was actually a half cent that I paid. I got 32 and a half cents, somewhere around there. This was down pretty aggressive. For those of you that don't know, Fission Uranium is it's a small cap uranium play. It's a single project mine in the Athabasca region. It's very close to the surface. All-in sustained cost, $7. It's the lowest cost producer. I thought it was a buyout. I was down 75%. I put small positions on these. I leave them alone. It either pays out massive or it doesn't. In this case, I was down 75%, but right now, after today, it's up about 100% since 2019. It's okay. It's all right. What else do I own Deep Yellow as well. I've got a small position in these are much smaller positions. I bought this a lot earlier. Again, I was very early in uranium. I think I paid 28 cents in around this region. Back in 2017, I was down as much as 62%. As of right now, it's up 304%. But here's the thing about uranium miners that a lot of people miss. This was a $40 million company. It was a $40 million company when I bought it. It's up 300%, so it should be 120 million. It's 800 million. A lot of dilution. I was expecting dilution, but not that type of dilution. The reason why I bought DPLO is because of John Borshoff. Absolute stud. Absolute stud. And John Borshoff is the guy that took Paladin from like half a cent to, I think it got up to $10. So you would have made like, I don't know, 1,000,000% or something like that in 4 years. So the guy knows what he's doing. He got completely ambushed at the corporate level. And yeah. I did cut my position in this last September, just to be very clear. So I did have a small position. I've got a much smaller position. I cut my position in Cameco. And by the way, for those of you that are wondering why Cameco is not in the portfolio, Cameco was only listed when I was reducing last September. So that's why it's not in the portfolio. I just didn't think it was a good price. So, and then Paladin, I've got a small position in Paladin. I got in this at like 8 cents. These are small positions, but it's not much. And then I've got Transocean, but I have that now in the portfolio. Outside of that, nothing really. That's it. That I can think of. So yeah. So besides that, I've got some digital assets that are just like the house's money. I think I'm up on all of them. Might be down a little bit since I started adding into these. But I'm down on the position we have in the portfolio. Like my original position was $7. I just ramped it up in CleanSpark. HUD 8 might be at break even. I got in close to the lows, but I added along the way up. So I don't know. I might be at break even. I'm not sure. We'll see. You're very welcome, Raz. Fission and DPL are in there, the smaller positions. But yeah, that's one thing you need to keep an eye on with those uranium miners. Dilution is quite heavy. It's quite heavy. Would you add Cameco to the portfolio? Yeah, that's my plan. That's absolutely my plan. So let's have a look at what my expectations are. So with uranium, so I've been involved in uranium since 2016, and my thesis hasn't really changed. But if you watch the video, the mistake that I made was on the demand side. After Fukushima, you started to see a phase out from Belgium, Germany, across Europe, Spain, France. I didn't realize the demand side. But from the supply side, it was nailed. All of it was 100%, and I think people are talking about it now. But one thing I realized is the average price that you need for uranium is $60 per pound in order to get to free cash flow positive. We're not there right now. So I don't think we're starting that big, massive wave 3 where we knock it out of the park until we start seeing free cash flow. So I don't think we're there right now. If you look at where we are with Cameco, if I just compare Cameco, let me just put it on a new scale. If I compare where Cameco is today versus uranium price, it's a little bit detached. We were at $64, which made sense for Cameco to start running. We're at 51. So I think negotiations for contracts are not going to be favorable until we get over $60 and it's profitable. So that's ultimately, I'm being very, very, very slow to add these. There's a lot of excitement recently with Japan bringing back online 3 new reactors and increasing their investment. But until we're above $60, they're still not profitable. So I don't see it as like a wow deal. Technically speaking, it looks very sloppy and overlapping. And a 1-to-1 with this wave A and C from a technical perspective would be in around $30. There's a bit of a disconnect between where uranium prices are versus where Cameco is. As energy rolls over, I think the Cameco and uranium miners might get hit as well. I'm looking at $18. That's a big difference between 29. So yeah, I am looking for it to be in the portfolio, but I do want to pay the right price. I don't want to just put it in because I like it long term. Like I know I'm down on a lot of positions, but I truly thought they were the right price. I'm not going to lie to you. So, I do try and time it to some degree. Fission's also great since it's close proximity to next-gen energies, high-grade deposit, which is the best discovery in recent years. If next-gen deposit is built, Fission will be as well. Yeah, and they just, I think, diluted 60%, raised some cash. So they're getting ready to do it as well. So thoughts on Zim? Already spoke about Zim. Seems like valuation is too good. Yeah. When we talk about valuation, $27 per share in cash. Now, when you're looking at a balance sheet, like let's look at Zim here really quickly. Zim, when you look at the enterprise value versus the market cap, enterprise value is debt debt, equity minus cash, right? So if the enterprise value is above market cap, normally you would see that debt is so big, it's much bigger than cash and it accounts for more. But the accounting rules changed. I can't remember what year, but we have to factor in capital leases as debt. Capital leases are an operating expense. So to give you an example of what a capital lease is, let's say I own a store, but I lease the store out and it's to sell vegetables or whatever it is. That rent is factored into my profits and it comes out at operating profits. So if we pop on over here and we have a look at financials, this operating margin factors in those leases. So I always exclude capital leases because it's an operating expense. If you got positive margins, those leases are not really debt. They're going to be serviced. It's like you can't have a store that sells fresh produce or whatever it is. You can't sell those fresh produce without that store. So either the business can't operate and you don't want to get involved in it, or it can operate, and that capital lease is actually an operating expense. So when you're looking at this here, on the outset, you see 3.9 billion and you see 5.2 billion in enterprise value. Seems like a lot. Let's have a look at its balance. Let's have a look at its balance sheet. Let's have a look at its debt. So you can only default if you don't pay your debt. Long-term debt, 164 million. Current portion of short-term debt is roughly 80 million. So they essentially have about $250 million in debt on $3.3 billion in cash. Right? So they've got barely no debt. The reason why net debt's so high is capital leases. Those capital leases are on some of their fleet. So you see current portion of capital leases. The reason why this is in current liabilities and not in total liabilities is because it's coming due in the next 12 months. So capital lease, you always check debt and then check current liabilities for the current portion of long-term debt that's coming due in the next 12 months. So I might take out a loan for the next 20 years, but if we're in year 20, it's a long-term debt that's coming due in the next 12 months. So that's essentially what that means. So there's $4.3 billion in capital leases. The net cash, if you exclude that out, $750 million. So the net cash position is really positive. That's net cash. You can calculate net cash as a percentage of market cap. What is it, like 16%, something like that? 33969 divided by 500. Yeah, it's about 8 times 12.5% net cash to market cap. It's a very cheap business. Rates are not expected to come down till mid to late 2024, so there's still a lot of opportunity there. But they've got a lot of shipping lanes with the United States. They dominate those lanes, but tensions are growing. And you've seen already with NVIDIA, they're not allowed to sell AI chips with AI capability to China. It impacts about 12 or 18% of their data center revenue. And yeah, look what happened. Got crushed. So geopolitics, a bit of a risk. You could start to see souring relationships there for sure. Okay, $60 a pound. Unless you are, because that time, yeah, okay, fair enough. On average, I think it's 60. There's a lot that's below. Like Cameco's profitable. I think they've got long-term contracts between $40 and $60, and I still think they're pretty close to profitability there. Oh yeah, I absolutely think we're getting to 100. My view hasn't changed. Interestingly, the longer it didn't work out, the more conviction I grew because, I don't know about you guys, but when things don't work out for me anyway, you get a little bit paranoid and you ask yourself, did you go wrong? I went over that thesis, I would say maybe 20 times a year. I know inside out what was going on in the market at the time, and that led to me to have more conviction because the power grid, like people don't realize this. Obviously, when you look into it a little bit deeper, in the United States, there's about 7 to 12% excess capacity on the US power grid. But what they don't tell you about that number is there are circuit breakers heading into the power lines, which kills about 7 to 8% of the energy. So the excess energy was below what it was anticipated. The capacity that supplies the US grid there's no excess room. When people were saying electric vehicles, mainstream, I'm like, where does the electricity come from? You need baseload energy. Solar is great. It's cheap. There's no battery technology to store it for the winter. Wind is great, but there's no battery technology to store it for no wind. And so you need baseload. You need a combination of all of these. Natural gas is a great solution. Coal is cheap. It's pretty darn dirty. Produces energy. And then you have uranium. The size of a jelly bean produces the same amount of energy as 1 ton of coal. The size of a jelly bean. And this here is the first from Stagfield, the University of Chicago, on the 2nd of December, 1942. Let's see that. This here is from that's a piece of graphite, by the way, from the first nuclear reaction ever. Pretty cool, no? So this was somebody that got involved in the trade with me back then, sent this to me from Chicago. So Stagfield, first, a little bit of history. Chicago Pile 1. It was underneath the stadium. It's pretty cool, no? So anyway, been in it for a while. It's been pretty frustrating, but it's playing out now. I think it was underneath the stadium of Stagfield. Anyway, I'm sure you guys don't care about it, but there you go. Piece of history right there. Not many people have that. Anyway, guys, not much else to talk about. I'm heading for 3 hours. If you guys want to talk about anything, fire away. Otherwise, we can do it again in a couple of weeks. Good to see that recovering. Pretty disappointing to see it down yesterday. Crocs. Everyone gave up on Crocs. Wonderful business. I just don't understand how you could not like this business. Everyone's so focused on the debt. Opportunity comes when sentiment's very negative. Look at this business. Gross margins continue to expand. Just something on gross margins. Roman, the recording, the link will play the recording. It's posted on the YouTube channel. You can watch it whenever you want. Think about gross margins with high inflation. Quick lesson for you guys. Let's say you've got a product. It's $100. Cost of goods sold. Your gross profit will be 6%. Let's say cost of goods sold $40. Whoops. Gross profit $60. Right? So let's say you have inflation. Cost of goods sold go up 10%. So your new cost of goods sold is $44. And so instead of making, you're still generating $100 in revenue, instead of making $60, you're making $56. So your gross margins come down a little bit. It's impacted you a little bit, the inflation, but you only need to pass on a 4% price hike in order to get to normalize that margin. Well, get close to normalization of the margin. The higher the gross margin, the better the business. Very few businesses in the apparel space that have 58%. In fact, you look at it relative to Nike, Crocs is way better consistently. The reason being is it's very cheap to make it. The cost of labor is very cheap because they operate in Vietnam, parts of China, and for local regional development. Selling and general administration comes down because there's an element of fixed costs. Such a wonderful, beautiful business. Return on invested capital extremely high, consistently above 20%. Growth is just phenomenal. Nobody wants to own this. And a lot of people are worried about the debt. And I think the one thing that you need to realize about debt is, how much leverage exists. Well, let's have a look at debt to, do we have net debt to EBITDA? 2.99 times. It's not that big of a deal. And that's due to the acquisition. Anything over 3.5 times is a bit of a challenge. Net debt, I think there's some capital leases in there as well, which is, you're going to ignore that, as we mentioned before. Interest expense is still in around where the market is. So EBITDA to interest expense, 14 times. So interest cover is fantastic. It's a great business. I really like the business. It got just bizarrely cheap. I was very frustrated to see it get down to where it did. I was very surprised to see it down at $46. Look, it's recovering and it's starting to, as those fears over slowdown starts to subside. You can see here, even in the latest quarter, 75% beaten in terms of earnings and year over year revenue, 70% to companies, 70% of companies have beat year-over-year revenue guidance on the latest quarter. I think fears are starting to subside. Share price, I still think there might be a little bit more downside, but I'm very excited about this one. This is our biggest position. Overstock's our second biggest position, so with a bit of luck, we're bottoming soon. The recording, same link. You can click on it and watch it whenever you want. Will I continue with live streams like this in the near term? Yeah, look, I'm not really interested in growing a big audience, certainly not in this sort of framework. I'll do something else on YouTube in the future that'll be a little bit more helpful. But the way in which I was doing it before wasn't good. So look, every once in a while we can do a live stream for a couple hours, hash out any of the sort of challenges that we have, make sure that everyone's on the same page. And I think it'll be a much better experience. Out of question, so pineapple on pizza, yay or nay? I actually like pineapple on pizza. I like anything on pizza. I like olives on pizza. I like a lot of meat on pizza as well. So, have I ever considered buying companies in the pet sector? Seems like demand is very consistent. Let me tell you something. I have 2 dogs. I've got 2 pugs. And one of them has never been sick for 11 years. And the other one was sick. The other dog's been sick 3 times a year, but not just sick. Earlier this year, 2 surgeries in order to fix his stomach. They had to cut a new hole for him to go to the toilet. Skin condition, nose condition, throat condition. He had a tumor a couple of months ago. He needed chemo. That dog was costing me probably a down payment on a house. But you have an emotional attachment to a dog, so you just pay it. I know more than anyone how expensive pets are. The pet industry is fantastic. Chewy, for argument's sake, that's an opportunity. But Chewy, I think Chewy's like the numbers in Chewy, which I've looked at, just don't make sense to me whatsoever. It's not profitable, which means more risk. And I'm not saying it's a bad company because it's not profitable, but I would rather wait till they are profitable consistently. 2024, so 2023, and then into 2024 looks like it gets to profitability. The problem is 7 cents in gap earnings. Let's go all the way out to 2027, which is a long way away. It may not deliver 160, but let's go out to 160. 160 divided by 34. By 2027, 34 divided by 1.6. I'm still paying 21 times gap earnings. It's just they're just a little bit too rich for me at these prices. And I know you can say valuation doesn't matter, but it does to me. I just don't get enough economic value. So there are some that are interesting for sure. I think there's another one, PetMed Express. This could be another opportunity, but I haven't looked into it. I don't really know much. I just know pets are expensive. So 1 second. Off topic. Why am I living in Spain? Because it's cheap. I didn't want to go to work. I studied, but I never wanted to work for anyone. I wanted to invest for myself. And so myself and my wife decided, we had a chunk of change. We decided to go to Spain, live on the coast for a few years, and keep building our wealth. So kept some cash in the bank to live, very frugally, and invested. And then over the years, my daughter was born in 2016. My son was born 2019. My daughter is very Basque. My son is very Spanish. But, we just, life kind of grew here. So that's why Spain. My wife's also Spanish. Actually, one last question. I have a similar view on copper as to uranium. Is this a space you've looked into? Last question. No, don't worry, Patrick. Copper is very interesting because if you believe in electrification in any way, copper is a very, very, very important material. If housing is going to continue to grow, copper is an important material. And I understand that copper piping is gone, but wiring is still copper. And the supply of aluminium and copper and primary metals in general is very tight. Copper is being pummeled. I haven't looked into it in a while, but a number of years ago, I used to own Freeport-McMoRan, and that was one hell of a journey. Reminiscent of a previous time, but I got hit pretty hard on this as well. It's not uncommon. I bought this at $8 and I got hit pretty hard. But there's a lesson in this as well. I mean, we had copper rising in 2015, 2016. It was bottoming out back above $2 per pound. Oil was pushing higher. Gold was pushing higher. And everyone was concerned that this company was going to go bankrupt while production was increasing. So in real time, you've seen free cash flows grow, yet everybody was worried about bankruptcy. I've seen that as an opportunity, but got hit in the near term. And that's sort of where I figured out a little bit about what's going on in the copper markets. 60% of Freeport-McMoRan's revenue is copper. If you believe in electrification in any way, which I do, I don't know how quick electric vehicles will grow, because I don't know if you guys have seen, but in California, they're using diesel generators to power their cars. So I don't know in the near term how it's going to evolve for electric vehicles. But that aside, gaming actually burns more energy than Bitcoin mining. Remember all the fuss about Bitcoin mining? Gaming actually burns more energy. So there you go. Bet you didn't know that. It's not to say anything about Bitcoin mining, whether it's good or whether it's bad. It's just to show you that there's a lot of stuff that generates a lot of electricity, and we need to solve it broadly with baseload power, going back to uranium. But if you're to build out batteries for solar and whatever it may be, you need a lot of copper. So I think there's going to be a long growth rate for copper long term. More iPhones, more smart devices need more copper. So yeah, but I haven't looked into it recently. Anything I'm considering selling. So I get absolutely steamrolled for looking at the macro, but I could have looked at the macro a little bit more with Royal Mail. Royal Mail is cheap business, monopolies on rural areas, 54% in terms of volume in the UK, growing nicely in Europe, owned a railroad in Canada, lots of cash. There are some issues with the union on pay, which I think is sort of a non-event. But one thing I didn't realize was 85% of boilers in the UK have natural gas boilers, very sensitive to natural gas. And at the margin, that's screaming higher. As the natural gas prices increase, what happens? Disposable income decreases, e-commerce packaging decreases. That's something that I kind of missed with this one. That being said, I think we're at peak fear anyway. And I mean, it's trading at a bizarre valuation. If we can get past that union and get a deal done, and electricity prices come down, disposable income improve a little bit, and it might, whatever you think about the new government, Jacob Rees-Mogg is very much a fossil fuel junkie, and that's the quickest way to get energy. So I think you're going to start, whatever you think about the environment, I mean, it is what it is. I'm just trying to think about where do we move from here. Rees-Mogg as your energy minister, he's going to give out a lot of licenses for oil and gas. He's going to deregulate an awful lot. If electricity prices come down, there could be a bit of a turnaround. But this is one that I would consider. Another one that I might consider would be, I've no reason to sell it right now. If a better opportunity came around, I'd do it. Another one to consider, I don't know. Oh yeah, Adobe. Adobe is a little bit rich price, but not right now. I think there's a bit of a rally to come, but yeah, it's looking quite corrective, and it's not the cheapest business. It's got a pure monopoly on creative software that's growing 30%, but it's a small segment of their revenue. Well, it's something like 4 billion or something like that. It's not small, but at the margin, it's producing decent revenue. Bottom line grows about 18%, but you're looking in 5 years at $20 GAAP earnings. $20 GAAP earnings, you're only at about fair value at a 20x multiple right now. So how does the equity price go up if you see moderation in that valuation? There's no margin of safety. So that's one that I consider. Yeah, both of those, maybe. But I have so many different opportunities to put there's so many different opportunities out there. Lots of them. If Overstock, Warner Bros, etc., were not as big as they are, I'd be averaging in right now. There's a lot of companies that like build this even a little bit more into MI Homes. Perfect time. I just built Citigroup up to our third largest holding. Digital Turbine is just bizarrely cheap. It's 35% growth on the bottom line at 14 times earnings. Builders First Source. Yeah, these are ones that I like a lot. Lennox International, I would love to get it to about, I don't know, 4%. I just don't think I'm getting that opportunity. Should have went heavier originally, but it is what it is. But there's a lot of opportunities out there. Pool Corporation, I'd love to build this one out further at these prices. Love the company. Just a fabulous business. But anyway. Really enjoyed the live stream. You're very welcome, Patrick. James, thank you for the live stream. You're very welcome, James. Roman, have a look at Wire. Fund manager Zek swears by it. Wire is not a bad business. I don't know much about it, but it came up on my screener. Yeah, it was cheap. Yeah, what do these guys do again? Electronic equipment. Yeah, this space is actually, it's heating up really well. I'll tell you why. Let's pop on over here for a second. While everyone's talking about doom and gloom, economy's doing okay and consumer confidence is improving. This is up off 50.5 and it's growing, right? So we're improving on consumer confidence. I actually have the spreadsheet which will show you just how entrenched it is. So I don't know if you guys can see that, but anyway, I'll try and make it bigger. That's 2008, and that's the sovereign debt crisis, and we're below there in terms of consumer confidence. The reason why this is important is because it's related to consumer spending. That being said, consumer spending hasn't slowed down. Debt continues to grow. And I broke down this data set. There's a lot of data in it. All of these are different data points. And I broke all of these down because I really wanted to understand what's going on with the consumer. Problem with the consumer is inflation expectations. So it should be no surprise that the gasoline peaked in June and consumer confidence bottomed in June. It should be no surprise. Inflation expectations coming down, inflation coming down, it leads to higher disposable income. In the United States, I think US consumers are saving about $500 million a day versus the peak on natural gas. And so consumer confidence is improving, more disposable income. I think consumer electronics are massively beaten down. Companies like Sonos as well is another one. Wire could be another one. I don't know much about it. What do they do? Manufactures and sells electrical building wires. Well, there you go. It's another play on the building space. Cables for interior electrical wiring. There you go. We're talking about housing, love housing. Builders First Source is one. Wire, absolutely. It's another potential play, absolutely. Obviously, I looked at it. Put some stupid pattern on it, but anyway. It's close to an all-time high, so it's pretty stable anyway. But yeah, it's not expensive. It's about 8 times earnings, I think, is what we've seen. But this space, even if there's a downgrade in earnings, I don't think it's going to be huge. If you look at this versus all-time, I mean, it's trading at its all-time low in terms of its forward price to earnings. Now, if you look at enterprise value to EBIT, pre-tax profit, it's trading at its all-time low. It's dirt cheap. Its growth is probably going to be consistent. There's no real guidance. 2023 is down, so it's factoring in a downgrade next year. Gap earnings $15, so 15. 125 divided by 15, 8.3. Yeah, it's already factoring into the drawdown. So even though it's going to slow down, it's still trading at low valuations. I mean, I'm not telling you guys to buy this. I'm just giving you an overview of what I think of it. Something changed in the last year, which gives them strong return on invested capital. Historically, it's somewhere around 10%. Gross margins, holy smokes. Gross margins, return on invested capital blowing out. Yeah, it looks interesting. It looks very interesting. Technically, no edge, zero edge. But if you were to hold this for a couple of years, you probably do very well. Could be very interesting, Okay, that's Roman was the last comment. Okay, guys, I think we'll leave it there. I'm starting to sweat a little bit here with this light on. Okay, guys, I'm going to leave it there. We'll catch up again in a couple of weeks. There's not always a huge amount to talk about. So I don't want to waste your time with a lot of stuff that's not really that important. But every couple of weeks we can touch base and yeah, hash out anything that we need to talk about it. So anyway, guys, I'm going to leave it there. Delighted to hear that, and we will do it again. Can you make this it is public, but even if it wasn't, I would have it on unlisted. So as long as you have the link, you'd see it. Very welcome, Roman. And yeah, we'll keep doing it. Anyway, guys, have a great day. And I'm looking forward to keeping in touch with you guys. All the very best, guys. Peace.